Hello everyone, I hope you guys are doing well and your studies are going in full swing. In today's video, we are going to discuss the all-important and the infamous May 2026 CA Final AFM paper. So over here, we are going to discuss the entire paper, all questions, theory, practical, MCQs, everything, and we will timestamp the questions as well. So in case you need help on a particular question, you can directly jump onto that question. Further, the solution in our format, we will be sharing this on our Telegram channel. So in case you want to kind of access this solution, you can review and download it from the Telegram channel. And there has always been, let's say, a lot of queries that we want new questions. So even the new questions which are based on the concepts which the institute can test additionally based on the stuff which may be there in the study material, we have also tried to incorporate those questions over here through a separate file, which will also be shared on the Telegram channel, and it will also be uploaded on the drive of the for everyone who has the lectures. But otherwise, in case you don't, you can download it easily from the Telegram channel as well. So with that, let's pray and get into the May 2026 paper. We will first start off with the descriptive section and then move on into the MCQ based case studies. So let's quickly start with the questions. First, you have this question from, in a way, foreign exchange as well as the AFM part. So let us quickly review. There is a company BIL, which is an engineering firm which is establishing a high-speed data center infrastructure in Republic of Valoria. The initial investment is 4,000 million Valorian currency, so it is valor. So this is your cash outflow. Under the agreement, BIL will sell the project back to the Valorian government after 4 years for a guaranteed price of 8,000 million. So this is, let's say, your cash outflow at year 0. This will be your cash inflow at year 4. This is 8,000 million valor. You are an Indian firm, and hence for you evaluation might be done in the Indian rupees. Now, during the 4-year operational period, BIL will provide technical maintenance and security protocols at an annual fee of 80 million. So this will be your cash inflow from year 1 to year 4 for the service that you are providing, which is payable at the end of each year. To hedge the foreign exchange risk associated with the investment, BIL's bankers have proposed a currency swap with the following terms. So if we try to summarize the terms of the swap over here, BIL will swap the principal of 4,000 VL for Indian rupees immediately at today's spot rate. So there is a counterparty that you have somehow found which needs maybe the Indian rupees, and they are ready to give you the VL, the valors. So over here, there's a swap counterparty which is ready to give us VL 4,000 to BIL, and in return, BIL will pay some rupees. This 4,000 I will use to invest in the project. So this will happen immediately. Now, the swap will be reversed at year 4 with both the parties re-exchanging the same principal amounts at the same spot rate locked in at inception. So whatever exactly we had received, so we had received 4,000 VL, that we will give back. So 4,000 VL, whatever we had given, that is the rupee amount, that exact same rupee amount will come back. So what is the spot rate? We'll have to see. The bank will charge an annual facilitation fee of 0.3% calculated on the rupee principal amount payable at the end of each year. So this is your expense. This is cash outflow from year 1 to year 4, but this will be recorded, let us say, in rupees. The currency swap covers only the initial investment and the terminal principal. BIL's policy is to hedge other foreign exchange cash flows using the forward contracts at the respective forward rates prevailing on the market. So we will hedge whatever is not covered using the forward rates. Now the financial data and the exchange rates, this is given as VL per rupee. So rupee over here is the base currency, is as follows. So the spot rate is rupees 50. Now if I look at today's situation, there is 4,000 VL, 4,000 million, and let's say this is VL per rupee. So your VL has to get cancelled. So you will divide this by VL 50 per rupee. So if I divide, I will get approximately rupees 80 million. So today, when I'm entering into a swap, I need 4,000 million VL, for which I will be giving 80 million rupees. After 4 years, I will again have to give back the 4,000 million and I'll get back 80 million rupees. So this will be at today's spot rate, and there is a 1-year forward rate, 2-year, 3-year and 4-year, and there is also a discounting factor at the rate of 14% which is available. Now there's a present value annuity factor at the rate of 14%. at 2.913. But what is 14%? A risk adjusted discount rate of 14% per annum is there. We are told to ignore taxation, and we are required to calculate the project's financial viability using the NPV method with all cash flows expressed in Indian rupees. So this is called as a home currency approach, where you convert everything into the rupees and discount it by the rupee discount rate. If nothing is given, the discounting rate of 14% will be the Indian currency discount rate. So if you look at your summary of the question over here, your initial investment is 4,000 BL. You will get back 8,000 BL, and every year you're going to get 80 BL. Apart from that, the bank will charge you around 0.3% on the rupee principal. Now, initially you have got a swap counterparty which is going to give you 4,000, for which you are going to give 80. 4 years later, this will be again exchanged back. So you will receive 8,000 from the project, out of which 4,000 you'll give to the swap counterparty, and they will give you back 80, the same amount as initially agreed. However, we are going to hedge whatever is remaining. So the remaining 4,000, that is 8,000 minus 4,000, is still unhedged, which will be let's say covered at the forward rate for the 4th year. So this is the 4,000 which is remaining. This is unhedged. This will be covered at the forward rate for the 4th year. Apart from that, the 80 VL that is going to be received will also be at the forward rate. So are we given the forward rates? Yes, sir. So when I try to do the capital budgeting evaluation, what I will do is I will say that what is my initial investment? Sir, initial investment is around 4,000 in VL. However, we have to convert everything into rupees. We'll convert this at the rate of 50. Remember, the base currency is rupee. It is VL per rupee. So you'll have to divide so that the VL will get cancelled. So at year 0, you will invest 4,000 VL, which is coming to around rupees 80. Now today's discount rate is the discount factor will be 1, and that will give you rupees 80. Now in each of the subsequent years you will receive 80. Now this 80 will be converted at the respective forward rates. So you have been given the forward rates. Alternatively, you could have even used IRP to find if the data was missing. So over here, these are all 53, 56. We will divide each of these 53, 56, 50, 9, 63. You will divide each of these in order to get, let us say, your cash flow in rupees, and this will be discounted. You want to find the NPV, discount rate is given at 14%, and you will discount it at the rate of 14%, the given factors, to get your answer. Here there's no problem in rounding off because the discount factors have been given to us. Now there's still something which is remaining, which is the remaining 4,000. 8,000 was received, against which for 4,000 is exchanged at the rate of 50 only. The remaining 4,000 will be at the rate of forward, which is 63.12. So over here for 4,000, this will be under the swap at the rate of 50, which will be 80, and the remaining 4,000, which will be at the forward, which will be at 63.37. You will discount all of these to get around 8.94. So this is your NPV, but this is before bank charges. You have not yet considered bank charges. The bank charges are 0.3% of the rupee principal. So 80 into 0.3% comes to around 0.24 in million rupees, but this is already in rupees, so you don't have to convert it into any other currency, and hence this 0.24 into, let us say, the present value annuity factor at the rate of 2.913, which is given to you, and you will multiply. So this will give to approximately 0.7, and hence even after considering all expenses and charges, the NPV comes to be a positive 8.24, and hence this project should be accepted. So since the NPV is positive, the project should be accepted in the first instant. So over here you need to kind of correlate the concepts of foreign exchange as well as some bit of capital budgeting. To be honest, this question is completely unfamiliar. It is not the same as what may be there in the material. However, if you sit independently to solve, you should be able to solve this. So this is your question 1 subpoint A. Now question 1 subpoint B is on something called as the H model. Now for this we'll put a separate YouTube video as well. However, if we review, usually how do you find the value of any asset in the world of finance? Or present value of future cash flows. Similarly, how do you find the value of any share? Well, usually using the Gordon's formula, d1 by ke minus g. This is if it is a single stage. However, if it is a multi-stage, maybe for 2 stages, 3 stages, etc., then you try to find the dividend at each of these years, and then once the dividend remains constant, you will take the terminal value and you will try to find the present value of the future cash flows. Now H model is actually an approximation, and it will help you to find, let us say, the value approximately using a particular formula. Now that formula we will review. But behind that, we'll quickly try to review the logic as well, though we'll have a separate detailed video for the H model working as well. So when I look at, let us say, the working here, so what is happening? Well, for example, there is a case where there is a dividend of rupees 10, this is D0, KE is equal to 20% and growth currently is 15%. Now, this growth linearly declines to 3%. This is a very clear requirement that in an H model, the growth has to linearly decline to a stable growth rate. If that is applicable, only then can the H model work. And we'll try to understand the logic also briefly. The linear declines to 3% over the first 4 years, which means technically you can find the value by taking the dividend for the first year. Maybe the growth is 15%. After that, it declines by, if it declines by 3%, so it becomes 12, then again declines by 3%, it comes to, let us say, 9, and then again declines by 3%, comes to 6. So this declines linearly. Let's say by 3% each year, you can find the dividend in each of the years. Then you can find the terminal dividend, and that's about it. You can solve it like that. So maybe your year 1 dividend grows at the rate of 15%. Year 2 will grow at 12%, year 3 will grow at 9%, year 4 will grow at 6%. And after that, probably the dividend will remain stable for the other years. So there's a linear decline from 15 all the way down, for example, to 6, and then the growth going forward will stabilize, for example, at 3%, for example. So over here, when I look at, let us say, this situation, let's say this is years 1, 2, 3 and 4, and then year 5 onwards the growth will stabilize to, let us say, a 3% growth in general. So over here, what will happen? Well, when I try to find the value, one option is you actually try to find the dividend for each of these years and then try to find the present value. That will actually give you the most accurate way to find the value of a share. However, the H model says that what is happening over here, if I try to find the value of a share, these are the years which I have put on the x-axis, and this is the growth which is there on the y-axis. Now, when I look at the value, this 3% is continuing, and let's say there is some value that is earned over and above in the earlier phase because your growth is greater than 3%. Now, because it is a linear fall, this forms a triangle over here. And in school, if you remember, you had this formula to find the area of a triangle. So what was the area of a triangle? Half into the base into the height. For example, this was the area of the triangle. So if I want to find the area of this triangle, that will be one part, but this is the area of this part only. Now there is an area below where the growth is remaining constant. So basically I can actually roughly put my formula where I can say that, well, the growth will remain at 3% in general. So if I look at D0 into 1 plus G of the stable growth phase upon KE minus G of the stable growth phase, this part will give me the area of this second point, the entire area. So let's say my dividend was 10 and it was growing at the rate of 3%, and that will be derived directly from this part. But to this you will have to add the area of the triangle as well, because your growth is not just 3%. So ideally this is half into the base. Sir, what is the base? This is 4. Now what the H model does is, instead of calling this as 1 by 2 into base into height, they call this number as H. So 1 by 2 into, let's say, the number of years. Over here in the y-axis you have the years, 1 by 2 in the number of years. Let's say this comes to, for example, 2 years. In which case, over here, if we review the working, this is 1 by 2 into 1 by 2 into 4, that is equal to 2, into, let us say, okay, hold on, this is D0 into H. What is H? H is half into the base into G of the high growth phase minus G of the slow growth phase upon, again, this is KE minus GS, because ultimately you are trying to find the present value. So over here, loosely speaking, when you look at the price of a share, the price of the share will equal to the present value of, let's say, this entire rectangle which is there below plus a triangle above. Literally, this is how this formula is derived, and hence there is a bit of approximation over here. So when you look at, let us say, the formula, you will say that, okay, d0 into 1 plus g, this is 10 into 1 plus 0.03 upon 20 minus 0.03. This will give you the area of the rectangle below, rectangle, and 10, that is a d0 into 1 by 2 into, let's say, 4 years. So this is into the height is 15 minus 0.03. So if I go to see over here, 15 minus 0.03, this is like the height divided by 20 minus 0.03. So if I take, this is 60.59 plus 14.12, this comes to around 74.7 approximately. This can be, let us say, taken as a base to understand the H model. Now, the question over here tells you in point B specifically to solve as per the H model only, and hence you will have to solve it accordingly only. Now, XYZ recently paid a dividend of 40, so this will be D0. The company is entering into a 5-year transition phase where the current growth of 15% will linearly decline to a stable growth rate. They don't tell you what, but they clearly tell you that it will linearly decline. So that is that hypotenuse, if you call it for a triangle, will be clearly formed. The transition period of 5 years, there's a decline of linearly from year 1. The current data, there will be an ROE of 20% and a retention rate of 25%. So they've given you this. However, you have been given current growth rate, so you will take current growth rate of 15% only. You will not fit to calculate, because if you calculate, you will get some other answer. So maybe there may be some printing issue over here, but if a growth rate is clearly given, you will have to take that growth rate directly. The terminal data, that is 6 year and onwards, has an ROE of 12% with a retention rate of 50%. So ideally, if I look at G for the stable growth phase, I'll have to look at R, that is 12, into B. B is around 0.5. So this is 0.06. So 6% will be a stable growth which was not given, and hence this will be around 6%. Okay. The market data requires a rate of 13%. So this is KE, and the market price currently is rupees 850. You are required to find the intrinsic value using the H model, and hence we'll have to do it using the H model approach only. So the H model approach over here will have the formula of D0, which is 40, into 1 plus the stable growth of 0.06 divided by KE of 13 minus 0.06. This will give you the area of the rectangle below. And for the triangle, you will have, let us say, H. H is equal to 1 by 2 into, let's say, 5, that is equal to 2.5. So if I look at D0, D0 over here is 40 into H. Maybe this is, 2.5 into the growth. Well, the growth over here is 0.15. This is a height, minus 0.06 upon 0.13 minus 0.06, and that is about it. So this is what, 40 into 1.06 divided by 0.07. This comes to around 605.71, and 40 into 2.5 into 0.09 divided by 0.07. Maybe this comes to around 128.57. If I total both of these, this comes to around 734.29, which is the intrinsic value using the H model. Given the current market price of 850, assess whether the share is undervalued or overvalued. Sir, it is overvalued. In the market, it is worth 850. As per H model, the value should be 734. And calculate the percentage deviation from the intrinsic value. They have given you two alternatives. You can either calculate 850 minus 734.29. They have taken deviation from the intrinsic value, so I'll preferably take it as a percentage of the intrinsic value only. Alternatively, you can also take it as a percentage of market price, is what the institute has given, both the alternative solutions over here. So this comes to around 15.76%, which is a deviation from the intrinsic value. So over here, if you review the H model, you will see the H factor is 2.5, that is high growth period, transition period divided by 2. Growth over here is 15%, stable growth is around 6%. The formula for the H model is given to you, and from that you will apply and get around 734. This is overvalued because the price is 850, and the deviation as per ICI can be calculated in either of the two ways. Because they say deviation from the intrinsic value, I'll preferably go with the first approach. Now, when I look at the next question, it is more of a theory question, and it's generic theory. So MT has approached you for an additional loan of 20 crores to fund its aggressive expansion plans. The company's current sustainable growth rate is 10%, but it aims to grow at 16% annually. Remember, the concept of sustainable growth says that this is a growth that the company can manage even with its own retained earnings, even if there's no external funds or external financing. However, if it wants to grow at 16%, it has to raise external finance because its own internal growth is not sufficient. Its debt to equity ratio is already at the maximum permissible 2.5:1, which means you cannot raise funds through debt. But they are approaching us for additional loan. Ideally, that should not be advisable. Additionally, the industry is experiencing a 5% inflation, which is increasing the company's asset financing requirements. So there's a 5% inflation as well. As a credit analyst, you are required to explain the key concerns regarding this loan request and suggest two alternative courses of action available to the company to achieve its growth rate sustainably. The first key concern is you cannot raise additional debt because you are already at the maximum debt to equity ratio, so further debt is not advisable, it is not even possible. Secondly, your aspiration of growing at 16% cannot be met at the current levels because your sustainable growth rate is only 10%, and if you cannot raise debt, it is difficult to grow at 16%. And lastly, because there is an inflation as well of 5%, and if let's say you want to look at the real growth, you have to ensure that this inflation is also kind of covered. That will also eat up into your overall workings. The way you move out of this is either you raise funds through equity, that is raise the additional finance through equity, in which your debt to equity ratio problem is in a way solved, and that additional equity money can be used in order to increase the growth rate. Or if you're not okay raising equity for whatever reasons, then you have to normalize your growth expectations from 16% to, let us say, around 10%. So the key concerns is excessive debt risk. There's a growth rate mismatch between the internal sustainable growth rate versus what you are aspiring for, and the inflationary impact should also be considered. So these are our key concerns. Secondly, the alternative courses, we can raise funds through additional equity or reduce our expansion rate to a level of 10%, which we can manage. So that takes care of question number 1. Next, we look at question number 2. At the beginning, there is a relatively easier question when we look at arbitrage pricing theory or multi-factor model from the portfolio management section. Let us review. Mr. RJ owns two securities X and Y which are priced according to a two-factor APT, clearly given that these are as per APT. The factor sensitivities and expected returns are as follows. So you have been given the factor sensitivities, the beta for these factors, and the expected or the actual return of the security. So whether expected and actual are one and the same. The additional information is risk-free rate is given. Risk premium for factor 1, this is called as lambda of factor 1, and risk premium for factor 2, which is called as lambda of factor 2. These are given to you in a typical question. These were not given here, they have been given. You are required to evaluate whether the securities X and Y are correctly priced under the two-factor arbitrage pricing theory. Sir, what is the formula? Well, for the arbitrage pricing theory, this is risk-free rate upon lambda of factor 1 into beta of factor 1 plus lambda of factor 2 into beta of factor 2. This will give you your required rate of return, and you will compare this with the actual / expected return. So let's say for security X, this is 6% plus this will be around 4% into 1.2 plus 5% into 0.5. So if I were to solve for this, this is what around, if I'm not wrong, this comes to what, 13.3%. And if you look at your expected or actual return, this is 14%. So this is giving you more than what is required, and hence based on that we can say that the security X seems to be undervalued. It gives us a return of 14 when we require around 13.3%, and hence our recommendation should be buy. So as you can see, 13.3% compared with 14. Now that same analogy is applied for Y. You would say that 6% plus 4 into 0.8 plus 5 into 1.4. If I go to see, this comes to around 16.2%. However, if you compare this with 16, I'm requiring 16.2. They're giving me only 16, and hence this is overvalued. It is giving me less than what I'm requiring, and hence this security ideally should be sold. So point 1, I would say, is quite easy if you hold your nerves. Even in a paper like this, there are certain opportunities to score marks as well. So this is sub point 1. Then look at sub point 2. Mr. RJ has 1 lakh available and intends to construct a long short portfolio by taking a long position in security X. Okay, so you are going to go long in security X and a short position in security Y. Okay, so they in the paper use the words A and B, which was a little confusing, but let us say over here X and Y, you are required to analyze and determine the amount to be invested in security X and that to be sold short of security Y. Remember, if you are investing, then the weight is positive. If you are going short, let's say the weight is negative. If the desired portfolio sensitivities are 1.4 with respect to factor 1, so this is your portfolio beta of X and Y, and 0.05 with respect to factor 2. Now they have solved in a particular way. Definitely alternative method, which is a lot more easier, is possible. So what we can do is we can use the portfolio beta formula. So beta of factor 1, and you take X and Y. This is weight of X and beta of X to factor 1 plus weight of Y and beta of Y to factor 1. Now if I look at my desired weight, this is desired beta, this is 1.4. Weight I don't know, let's say weight of X and beta of X to factor 1 is 1.2, and weight of I don't know, maybe this can be 1 minus the weight of X, and this is beta over here, this is 0. Uh, uh, this is 0.8 again to factor 1 for security Y. So this is into 0.5. Now if I were to solve this equation, and that is about it, I would get the weights. You can have multiple alternative methods to find this answer, but if I just solve for this, you will get the answer. So this is 1.4 equals 1.2 Wx plus 0.5 minus 0.5 Wx. So if I take 1.5 on the other side, this comes to, let's say, 0.9 equals over here 1.2 minus 0.5 comes to 0.7. So this is 0.7 Wx, and hence 0.9 divided by 0.7 comes to around 1.28 or something. Let me just verify this once. Over here, no, sorry, I've done certain mistake. I think this is 1.2. My desired portfolio is 1.4 and this is 0.8. I've taken 0.5 by mistake, my bad. So over here, if easy marks are available, we lose those easy marks by doing silly mistakes. Sir, you do silly mistakes. We never do silly mistakes. Take care. I'm sorry. My bad. So this is, let us say over here, this is 0.4. And if I take 0.8 on the other side, this will be 0.6. And hence your weight of X will equal to 1.5 and the weight of Y will be equal to a negative 0.5. So if I have 1 lakh rupees to invest, I can say 1 lakh into 1.5, that is equal to 1,50,000 will go in X, and 1 lakh into a negative 0.5, that is a negative 50,000 will go in Y, and that's about it. Sir, but we want to verify, okay, so and factor 2 is 0.05. You can use that for the purpose of verification as well. Like for example, if you stick to the same weights, or even if you, like I have shown you this working to show that even if you start with 0.5, someone says, why did you start with the first factor? You can start with the second factor. Yes sir, we can do that. So this is 0.05, and if I take the weight of X into the beta of X, this is 0.5, and the weight of Y into the beta of Y, which is 1.4, and you solve for this, you will still get exactly the same answer. Basically, you can even verify this for factor number 2. You can say that, okay, this is 0.5 into 1.5 plus 1.4 into a negative 0.5. So if I go to see, this is 0.5 into 1.5 and 1.4 into a negative 0.5, you will get exactly 0.05, which is your desired factor exposure to factor 2. So what are they asking you over here? Well, they are asking you to find on how to construct a long short portfolio. We'll say 1.5 long X and 0.5 short Y, and that's about it. So that takes care of question 2A pertaining to portfolio. Now question 2B is given pertaining to derivatives, and over here there is a concept of something called as intrinsic value and time value. Now when you look at a value of an option, so when you look at an option value, basically this is the premium. What is the value of an option? So the premium that you have to pay. Now ideally, if I look at an option, which has, let's say this is a call option, which has a spot price of 100. Today, exercise price is, let us say, 80. Therefore, the intrinsic value, if you go to see, is 20. That means today itself, if I take today's position only, the option carries a 20 rupee value. Even if there is no change in the price, the option still commands a 20 rupees value. However, the time over here, so let us say you are on the date of expiry. So if you are on the expiry date, the option will usually trade at around 20 rupees only because you are on the expiry date. However, if you are before expiry, now there is some time which is available. So if you are before expiry, let us say there is still 3 months remaining, and the spot price over here is given to you as 100, exercise price is 80. Do you think the value of the option will be 20 only? No, sir, it can be something else. Maybe you can use binomial, you can use Black-Scholes, and the value comes to 30. Now, the problem is, someone might say, why is the value 30? Well, I am sure that even if the spot price of today were to continue, the value of the option is 20. But the remaining, well, there is some uncertainty. There are still 3 months remaining, and hence the share price can possibly change. And hence, because 3 months are remaining, there's a 10 rupee time value. So time value just means the excess of the option's actual premium as compared to the intrinsic value. Now you have to ask yourself, why is it called as time value? You ask yourself that if this is the position at expiry, if this is the position at expiry, then no one is going to pay you anything beyond 20, because if you are on the date of expiry, your options premium will be equal to the intrinsic value. But because there is some time remaining to expiry, people expect that you will probably make some more return, or there can be some fluctuation which can be favorable, and hence they are ready to pay slightly more. So basically you can say that if I look at option value, if you look at option value, from this you subtract the intrinsic value, you will get what is called as the options time value. Okay, that is one thing. Second is options being in the money, at the money, out of the money. If the option is likely to be exercised, it is called as in the money, ITM. Option is unlikely to be exercised, it is called as out of the money, OTM. If the option is exactly spot and exercise price are the same, it is at the money, ATM. So over here, if you know these basics, you should be able to answer for sub point B. On 1st July, Alps company shares trade at 2000, this is S0. An investor enters into the following options. These are having a 3-month maturity. So there are 3 call options, ABC, and 3 put options, and there is a premium which is given, and there is strike price 1920, 2000 and 2080. Similarly, 1920, 2000 and 2080. Perfect. The contract size is 100 shares. So this is like lot size. One option will have 100 underlying shares. The risk-free rate is around 6%. Continuous compounding not required. We would not even have done this. And the stock does not pay dividend. Ignore transaction cost. Assume investor chosen any one option. So you will do this for every option separately. Assess the ITM, ATM and OTM of each option, A to F at initiation, and evaluate the intrinsic value and the time value components embedded in the premiums. So basically, what does in the money mean? The option is likely to be exercised. So when will the call option be exercised, sir? The call will be exercised if the spot is greater than the exercise price. You get a chance to buy at a cheaper price. So over here, if I go to see, the price today is 2000. Strike price over here is 1920. You would love to buy at the cheaper price. So this option is ITM, in the money. In the second case, it is at the money. I mean, this is exactly the same spot and exercise price. This is your spot. These are your exercise prices. And in the third case, you are getting a chance to buy at 2080, something which is available at 2000, and hence this is out of the money. This is OTM. Now, when you look at the put on the other side, when will the put be exercised? When the spot is less than the exercise price. You would love to sell at the higher price. So when the exercise price is higher, that is when put will be exercised. So now if I have a chance to sell at 1920, we'll say no, I will not sell. I will might as well sell in the market at 2000. So this is out of the money. At 2000, this is at the money, but at 2080, I would love to sell it at 2080, and hence this is an in the money product. Okay, next you look at the premium. Now these are the premiums which are given. Now you will try to find the intrinsic value. Remember, intrinsic value, this is the premium, this is the option value. Intrinsic value is the difference between the spot and the exercise price for a call, and exercise price and the spot for a put if it is positive. So over here intrinsic value is 80. Here it is 0. Here also it is 0. I will not exercise. So there is no intrinsic value only. However, the option still has a 45. So that is the time value. So when I look at the time value, well, this is 130 and 80. This is 50. This is 85 entirely time value. This is 45 entirely time value. Why are people ready to pay 45? Today the price is 2080. Sorry, to the price is 2000, the excise price is 2080. Why are people ready to pay? Well, there's no intrinsic value as of now, but there is still maybe 3 months remaining for the option maturity. So maybe for the time that is available, people are ready to pay probably 45. Put option over here is out of the money. Again, intrinsic value is 0, in which case is 40 is entirely time value. Over here, this is 95. Intrinsic value again is 0 because put is at the money, there's no intrinsic value per se, but here the put has an 80 rupees intrinsic value. You are having a chance to sell something at 2080, which today is available at 2000. So there's an intrinsic value of 80, and if I look at the time value 95 and 155 minus 80, this is 75. So it's a good practice question for the concept of intrinsic and time value. Sub point 2 says, in the next 3 months, expiry price may increase by 150, or expiry price, that is spot at expiry, may increase by 150. So this will become 2150, or it may decrease by 150. So it may become 1950, either of these two. Under each expiry scenario, examine which options will be rationally exercised and appraise the net profit or loss. So over here, the institute has ignored the discount factor because they have only asked to find the net profit or loss. It is like a payoff, and in payoff, you don't take the interest rate. Otherwise, the interest rate is given. You could have considered that as well. Institute has also ignored. We will also ignore the same. So when we are looking at, let us say, the working here, so we have discussed this intrinsic value, time value working. Now, if the price becomes 2150, call options are right to buy. You would love to buy at a lower price. If the price becomes 2150, your call option at 1920 will definitely be exercised. The call option at 2000 will also be exercised. But the call option at 2080, I believe, will also be exercised. You have a right to buy. So all the 3 calls will be exercised. Whereas put is a right to sell. You would love to sell at the higher price. In the market, you can sell it at 2150. Then why will I sell it under the option either at 1920 or 2000 or 2080? All the puts will not be exercised. Okay, now if I look at the payoff over here will be 2150 minus 1920, 2150 minus 1920, the payoff comes to 230. Now, this is a payoff. However, the question tells me to calculate the net profit. I have not considered the premium over here. Sir, what is a premium? Well, in this case, the premium is 130, so minus 130, and hence the net payoff is 100. This is net profit. Net profit is like net payoff. You don't need to do time value adjustments. Even over here, they have not done time value adjustments. Okay, next you look at the net payoff of 100, and this is per option. One option has 100 underlying shares into 100, so net profit will be 10,000. Second, in case of an option, you will have 150 as the payoff, 2000, 150 minus 2000 minus whatever is the premium. The premium over here is 85, this is 45, so this is 85, so this is 150 minus 85 comes to 65 into 100, this is 6500. Okay, and then when you look at the third case, there is a payoff of 70 minus a premium of 45, so this is 25 and this is 2500. In case of a put, the payoff is 0 everywhere, and as a result over here this is 40, 95 and 15, 155. You will multiply this by 100 because this is per share and every lot has 100 shares, and that is it. You'll have your losses of 4000, 9500 and 15500. The exact opposite will happen in case the spot price touches 1950, in which case the calls will not be exercised because you have a right to buy at either 1920 and the price has 1850. Why will I exercise? I might as well buy at 1850 or at 2000 or at 2080. Calls will not be exercised, and hence the calls over here will have a 0 payoff. You'll still have to pay the premium, and you'll have the net payoff into 100 will give you the final answer. Puts over here will be exercised, all the 3, because you have a right to sell at either 1920 or 2000 or 2080 when, let us say, the price is 1850. So the put will be exercised. In the first case, 1920 minus 1850, that is 70, minus a premium of 40, that is 30, gain into 100, that is 3000, then 5500, and then 7500, as the case may be. So this is question number 2B. Next is a question on startup finance, and this is more like a true or false. I mean, it's a theory question. What are they asking? A technology startup, FinCorp, is in early stage growth and is evaluating multiple sources of financing, including angel investment, venture capital, and convertible notes, IPO, etc. Evaluate the following statements and state whether true or false with justification. In the early stage startups, valuation is primarily based on DCF. Clearly false, because you don't, it's an early stage startup, you don't have these earning trajectory, and hence a multiple approach is usually much more suitable rather than DCF. This is false. Venture capital financing typically involves staged funding. Stage means seed stage, early stage, let's say series 1, series 2. These are staged financing to reduce agency problems and mitigate investment risk. I would say it is true. Usually venture capitals have various series or stages, and hence this comes as staged financing. Bootstrapping, that is funding on your own, reduces dilution risk. That is, you remain the owner only, but may limit growth due to capital constraints. That is correct. Like beyond a point, how much money will you yourself have? Angel investors generally come at a later stage than venture capitalists and demand stronger control rights. The answer is clear false. Angel investors are in fact the earliest investors, and they don't really come late, and hence this kind of helps you. So this is FTTTF. So over here, this is false, true, true, and ultimately false. Perfect. So this takes care of question number 2. Next, we go on into question number 3. Now, this question Institute has given 2 alternative solutions. The first one is shorter, but in my opinion, not very logical. The second one is longer, but in my opinion, a little more logical, and hence we have solved this entire solution considering the second alternative. Let us review this question. An Indian company is investing in a 2-year project in euro. So this is again a question which involves a foreign currency investment. Like question 1A also had this, and even question 3 has this. So Indian company is investing in a 2-year project in Europe. So it is investing in euro. The initial investment is 4 million euro. Annual after tax operating cash flows are 2.5 million. Perfect. The life over here of the project is 2 years, and unlevered cost of capital is 12%. So over here, this is unlevered cost of capital, which means this is as if the project has no debt. It is just the operating risk of, so this represents the operating risk of the project. This is usually helpful when you look at adjusted present value concepts. In adjusted present value concept, you calculate the NPV of the base project, and you say that, well, I will look at the operating risk of the project irrespective of how it is financed. Is that project viable? And then we say that, well, the debt over here essentially gives you certain tax shield or tax savings, and to this you can add the present value of the tax savings on, let us say, interest. Now, in the adjusted present value concept, if you are aware, what is done is you will take your project cash flows at the project risk, like irrespective of how you finance. If I were to buy a house, then whether I buy the house from my own money or borrowed money, what is the risk in that investment proposal? I'll find the NPV of the base project at the unlevered cost of capital, and then if I were to take debt, maybe I will get some tax savings on interest. So to find my final adjusted present value, I will add the present value of tax savings on interest. Now, interest over here is a financing cash flow, and financing cash flow is having a different degree of risk as compared to the operating cash flow. And as per the institute questions, study material, solutions over here, you will discount these debt related cash flows at the pre-tax interest rate. They've done this. There are 2 alternative methods here. They've done using one of the methods, though there's a separate alternative method where you take all debt cash flows is also possible. But if you keep this consistent with the institute's solution over here, you will try to find, the question will ultimately ask you to calculate adjusted present value, where you try to find the NPV of the base project, and that is discounted using, let's say, the unlevered cost of capital, that is operating cash flows discounted at the operating risk, and you look at the financing aspect, that is the interest, tax savings on interest discounted at, let us say, the pre-tax interest rate. That is done by the institute across the board, and hence that is also done in this question. We will do the same. So that is regarding certain brief background of adjusted present value. So the spot rate is around 90 per euro, and the corporate tax rate in India is 30%. Okay, financing options are 50% debt is required. So maybe out of the 4 million, maybe there will be a debt requirement of around 2 million. 50% debt. But that debt, there are three options. You can borrow in India, in INR, in Euro, or in USD, and the rates are different at each of these places. Now, the additional data which is available is spot USD INR. Well, this is like the SWIFT code, and USD INR over here is actually rupees per dollar. I mean, USD INR is not dollar per rupees over here. 75 is rupees per dollar, and Euro USD then will be dollar per euro. Okay. Interest rates in the US is 3%, that is also given over here, and in Europe is 5%, that is also given over here. You can assume IRP holds and no transaction cost. Like in question 1A, the forward rates were given, but here the institute has not given you forward rates, so you'll have to unfortunately calculate it. You required identify which option is the cheapest and why. Now, in my opinion, the solution which is as per alternative 2 is a lot more logical. Option 1 also they've done something, but better you can do as per option 2. If you are comfortable with option 1, you can even do that. We'll discuss one of them which we think is logical. So over here, what they say is you figure out which of the option is cheapest. Well, we'll say that, well, you know what, let me borrow in India. If I have to borrow in India, what is the rate at which what is the amount that I'll have to borrow? Well, this is 4 million. 50% is the debt, so that is 2 million into rupees. Well, today's rate is rupees 90 per euro. Now, the problem is on an Indian borrowing, this is 2 million euro into 90, that is around 180 million. Now, this 180 million rupees that I'm borrowing, I'll have to pay interest. So, 180 into, let us say, I believe 9%. So this is 16.2 when it comes to, I think, million. 16.2 million is the amount of interest that you will pay. However, this is in rupees, so there's no problem. Then again, 16.2 is a million interest that you will pay in the second year. Again, this is in rupees, no problem. Ideally, one can say you can do 1 minus t. In my opinion, yes, you can do. However, Institute has said that if that same tax rate is to be multiplied at every place, then what is the point of multiplying by tax? We just have to identify the cheapest option. So they've ignored tax in the first case. Ideally, they should consider tax in the first case. They have considered in the second case while doing NPV or APV. But even in the first case, they can consider. But even if it is not considered, it is the same 30% that will be applied everywhere. So either you consider at all or ignore at all. It does not make a difference ultimately. And hence, you can either consider that 30% at all the places, or you can ignore the 30% at all places. Institute has ignored the same. So if I look at INR, in year 1, you are paying 16.2. In year 2, you are paying 16.2. And at year 2, you will also pay the rupees, I think, 180 million at year 2. So this will give you your total cost. They have ignored time value as well over here. Should that be considered? Well, in my opinion, probably yes, but they have not considered. So when I look at the Indian borrowing overall cost, this comes to around, when you repay, this is around 212.4 for the Indian borrowing. Now, when you go to the Euro borrowing, well, you will borrow 2 million euros. Now, at the rate of 5%, your interest will be 2 million euro into 5% comes to 0.1 million euros in the first year, 0.1 million euros in the second year. But I'm an Indian company, I want to find a rate in rupees, and hence I'll have to find a forward rate. Similarly, when I look at the dollar borrowing, I would say that, well, you know what, the rate is spot rate is 1.2, so maybe there's 2 million euros I need in dollars. This will become, let's say, euro has to get cancelled into 1.2 per euro. So this is 2 into 1.2. This comes to around $2.4 million into, let us say, the rate of 3%. So into 3%, this is coming to $0.072. So these are your interests. Now you'll have to calculate the forward rate, and forward rate can be calculated using IRP. Now there is no rocket science over here. If I can do it for one of the rates, I can do it for every rate. So if, let's say, there's a rupee per euro rate of 90, this is your spot rate. I want to do F divided by S, that is 90 into 1 plus the interest rate in India, which is 0.09, upon the interest rate in the Europe, which is 0.05, and hence 90 into 1.09 divided by 1.05, this comes to 93. Institute over here has taken surprisingly just 2 decimals. The question over tells you usually for discount factors we take around 4 decimals. So if I were to take 93.4286 is what we have taken, but if you see the institute solutions, they have taken just 2 decimals, so it is a little arbitrary again. So over here, when I look at rupee per euro rate, it was 90, then this comes to around 93.4286 and 96.9874. Similar is the case for each of these cases, you have rupees per dollar which is available at 75, dollar per euro which is available at 1.2 and 90. So everywhere spot rates are available. Based on that, you can find the 1 year forward rates, and then you can find the 2 year forward rates as well. So this is a simple IRP calculation. It is just that it will take some time. Usually we take up to 4 decimals. Institute has taken up to 2 decimals over here, a little arbitrarily. So when I look at, let us say, this calculation, I would say that, okay, when I borrow in INR, that is clear. I'll borrow 180. Interest for the first year is 16.2, second year is also 16.2, and hence this comes to a total of 32.4. In the second year, the repayment will be 180. I'm an Indian company, so total repayment is 212.4. There's no separate forward rate to be taken here. But when I look at euro, I did not earlier have the rates. Now I have the rates 93.4286, 96.9874. So I will look at this interest of 1 million, 0.1 million, and multiplied by the respective rate. So this will give me the amount of interest in rupees. Then at the end of the second year, 2 will be repaid at 96.9878, and hence this is 193. So total amount will be 19.04, and 193.98 will be around 213.02. If I compare it with the rupee value, which is 212.4, we have done this in million. In your printed solution, everything is in full number, so you'll see a lot of zeros per se. And then when you look at the dollars, we said that, okay, the rate is borrowing is 2.4 into 3% into 3%, and you will multiply by the rates. So this is 79, this is 83, 11. Ultimately, you will have 201, that is 2.4 will be repaid at the 83.99. 24 rate, which is around 201, so 213.13. Basically, it is cheapest, at least if I follow this version, to borrow in rupees, because ultimately the repayment is the lowest. It is 212.4 as compared to 213 point something under the dollar and the euro. Again, ideally, can you consider tax? Of course, yes, you can consider tax at all places. You can do 1 minus t. Your ultimate answer will remain the same if you're multiplying the same value everywhere. Or you can ignore, institute has ignored, and I don't think there's a problem over here. But can you consider present value? Again, yes. But over here, the present value also, if you take, let's say, at the discounting factor, the idea over here is if you are converting everything into rupees and then finding the present value, then ideally you are multiplying the same discounting factors everywhere, and hence the institute has ignored. So we have ignored the same. Though if you consider the tax also, you also consider the present value and do the working, your answers will be the same. So we have mentioned that we have ignored the tax in line with ICI for selection, since the same tax rate is applicable under all options. Again, time value adjustments will be done in sub point 2 while calculating adjusted present value for the cheapest option. It is not considered over here because the same discount factor, the same rupee discount factor ultimately will have to be taken. Okay, so this is the sub point 1. Then you look at sub point 2. This is on adjusted present value concept. Compute the adjusted present value under the cheapest option. Now over here, this is a multi-currency approach, and hence in case of a multi-currency approach, the adjusted present value will be the NPV at the base plus the present value of tax savings on interest. Now, another way to find the adjusted present value was you can take the base NPV, and then you can take the project cash flows in debt. Now, the problem over there is, in general, in the sums that you would have done, the currencies would be the same. Here, the problem is the debt is taken in rupees and the project is in euro. And in a multi-currency approach, it is always advisable to solve it like this rather than taking the debt total cash flow separately and the project cash flow separately. So if I look at the NPV of the base project, I'll say, well, the base project over here has an unlevered cost of capital is 12%. And what are the cash flows? So the cash flows are 4 million. Had there been no debt, still 4 million cash outflow, and 2.5 million. So at the rate of 12%, do I have the discount factor? Yes, sir. At 12%, this is, let's say, 2.5 of cash inflow. This is 2.5 of cash inflow. So over here, this is 2.5 into 0.893 and 2.5 into 0.797, and this will give you a total of 4.225 minus 4, and hence 0.225. So 2,25,000 euros can be taken if I had to do it in euros. But the problem over here is I want to find everything in rupees. I am an Indian company, and as a result over here, I'll have to convert everything into the Indian rupee cash flows. So this 4 million I'll convert at today's spot rate, which is equal to 90. Whereas the 2.5 million I'll convert at the 93 point something and 96 point something rates, that is the forward rates, and then discounted at 12%. Sir, why? Well, if nothing is given, the cost of capital is always your local currency cost of capital. It is not the European cost of capital, it is not the foreign currency discount rate, it is a local currency discount rate. And as a result, when I do the working, I will start with 4 million, then 2.5 and 2.5. I'll convert it at the respective rates to get the cash flows in rupees. Even if there's no debt, these are the cash flows. This is the unlevered. This is the overall project operating cash flows, and the project risk is 12%. The discount is at the rate of 12%, and hence you will get the NPV of the unlevered project at around 41.83. What we did earlier was just in euros, but that is not correct, because the discount rate of 12% is not. A lot of students made this mistake. They said, okay, let us take the 12% unlevered cost. Or if nothing is given, your discount factor is a local currency discount factor, and hence you will have to convert this into your rupees and then solve. So we'll have to first convert these numbers into rupees, and then we will solve, and we will get around 41.83. Now, if I were to find the adjusted present value, the question tells me clearly to find something called as adjusted present value in a multi-currency setup. In a multi-currency setup, you will have to find the base, let us say over here, which is 41.83. Now, the next a point over here is to say that, okay, the borrowing cheaper is the Indian borrowing, and Indian borrowing has a 16.2 interest in the first year, it is 16.2 interest in the second year, the tax rate is 30%, so 16.2 into 30%, there'll be a 4.86 tax saving. If I were to take a, let's say, interest loan in India, I'll have a 16.2 interest into 30%, that is 4.86 tax savings or a tax shield. This has to be discounted at your pre-tax discount rate. You can look at the adjusted present value section in your material, and they have clearly told, we have also written this, I think, in the shield, that you will have to take the pre-tax cost of normalized debt as a discount factor for the financing cash flows, and Institute has also done that. So over here, a lot of, and logically, yes, you might say that, okay, that we are considering tax, so ideally we should take the post-tax discount rate. Logically, yes. However, across the board, even the unlevered cost of capital that you take, that is a 12% total discount factor, and even over here, when you take the discount rate, you have to take the remember that in the adjusted present value calculation, if I'm looking at the debt cash flows, the discount factor will be the pre-tax cost of normalized debt. Over here, your normal debt in India will have a cost of around 9%. So I'll not do 9% into 1 minus t for the purpose of my discounting. I will take, let's say, the entire 9%, and based on that, I will try to find. So over here, 9% discount factors are not given. Everything else was in 3 decimals. So I'll even take the 9% values at 3 decimal, 0.917 and 0.842. So you'll have 0.917, 0.842, so this is 4.86 into the present value factor at the rate of 9% for 2 years, and this will come to around 8.55. Now, this is further, let us say, benefit due to the tax savings, and this is also in rupees. The earlier NPV of 41.83 is also in rupees. So your adjusted present value will be the total of 41.83 and 8.55, so that comes to around 50.38. It is positive, and hence the project is to be accepted. Though there's an alternative, this is as per alternative 2, there's another version, alternative 1, if you want to review, but already there is a lot. So if you kind of get some understanding for this, I think that is sufficient. So we have given a bit of reference explanation under the APV method. Operating cash flows will be discounted the unlevered cost of capital, which is based on the risk of the project, that is 12%, and financing cash flows will be discounted the risk of financing, like the interest rate risk, and hence this will be at 9%. This will always be at the pre-tax discount factor. Over here will be, in APV questions, will be the pre-tax interest rate for the financing cash flows. So this is a bit of a problematic question for sure. Now, along with that is a question from mutual funds, which is relatively manageable. This is on the typical bonus and dividend plans, and let's review. This was a little more easier, I would say. A mutual fund offers 2 plans, the dividend plan and the bonus plan. An investor invests 12 lakhs in 1st April 25 in the ratio of 60 and 40, which means in the dividend plan they will invest 7 lakh 20, that is 60%, and in the bonus plan they will invest 4 lakh 80, which is 40%. The initial NAV of both plans is 48. Now entry load is 2%. Now that will be at the time of investment. I'll have to pay 2% extra, so there may be an NAV of 48 plus 2% will be 48.96. So for every unit, including the entry load, I'll have to pay 48.96. And there's an exit load at 1% on the redemption value that will be at the time of redemption. Under the dividend plan, a dividend of 5 rupees per unit is declared on 30th September when the NAV is 56. This is when it was declared. But after declaration, the NAV became 51. So the new units will be allotted at the rate of 51. Okay, but how many units are there? Well, maybe for the dividend plan, you will say 7,20,000 was my investment, 48.96 would be my value. So for 7,20,000 divided by 48.96 will come to around 14,705.88, let us say, units. Every unit 5 rupees into 5, if I go to see 14,705.88 into 5 will come to around 7352 9.4 of dividend divided by 51 NAV, and hence this is around 1441.75 additional units if you want to calculate. We have a detailed solution as well. Dividend is reinvested at 51 and the closing NAV on 31st March 26 is around 54. So this can help you in calculating the returns. But when you calculate the returns, if you have sold the units, you will have to even pay exit load. Now under the bonus plan, a bonus is of 1:4 which is declared on 30th September. When the NAV is 60, does not really matter. For bonus, it is directly based on the number of units you have. After the bonus adjustment, the NAV becomes 54 and the closing NAV is at 52. You are required to ignore taxation, evaluate the total return and the holding period return under each plan after considering loads, and assess which plan provides a higher effective return. Assuming you are selling at the end of the year, then what is the plan? So if I look at, let us say, the dividend plan, as you can see, 7,20,000 is my investment divided by 48.96 will give you 14,705.88 units. The dividend over here is 73,529 divided by 51, which is a relevant NAV at which reinvestment will happen, because it is only after the dividend that you can invest, let us say, the money hypothetically. That so the dividend, once it is declared, the money is received hypothetically and that money is used to invest, and when you go to invest, the rate is 51. So this is 1441.75. so your total units will be 14,705.88 plus 1441.75. your total units is 16,147.63. Now this is into 54, but this will be your gross proceeds minus there's a 1% exit load, so minus 1%, and you get 8,63,252 point something. And if I compare it with my initial investment of 7,20,000, there's a return of 1,43,252 divided by 7,20,000 of investment, and the holding period and the annual return is the same because your holding period is 1 year, so that is around 19.9% will be your return. Now when I look at a bonus plan, it is relatively easier because there's no reinvestment per se. So when I look at a bonus plan, I will say that I have invested 4,80,000. Again, the NAV is 48.96, so 4,80,000 divided by 48.96 will have 9,803.92 units. Now the bonus over here is 1:4, so there will be additional 2450.98 units. So if I total both of these, I will get around 12,254.9 into, when I sell, the NAV at the end is 52. Yes, the NAV in the middle changes, but that does not really matter. Into 52, the NAV is 52. So this is 6,37,254 minus there's a 1% exit load, and then 6,30,882 minus 4,80,000 that you have invested. So it's a gross 1,50,000 return. So that is a better return for sure. I've made a lower investment, but with that lower investment as well, I've clocked a higher return in this particular case, and the return is 31.43%. So the bonus plan gives me the higher return. This is a lot more easier and scoring, I would say. Okay, next you have this point C, which is a pure theory point on securitization, Institute's favorite chapter when it comes to theory. Transfer of NPS, non-performing assets, through securitization improves the balance sheet health. Well, how does it improve the balance sheet health? Well, because it takes these non-core assets out of the balance sheet. It makes the balance sheet of the company much more cleaner, but may also involve regulatory and valuation challenges. Well, because the regulators under the SARFAESI Act will, let us say, review, and it has to meet the terms of the regulatory requirement, comment on the statement above. So there will be a lot of challenges, like for example, this is a pure theory. We can review this, where you have, let us say, by removing NPS, you will reduce the gross NPS, improve the asset quality, better capital adequacy, you don't have to write so much. You can just write in your own simple words, improve investor confidence, etc. But again, it results in a moral hazard as well, because banks now will be a little more reckless when it comes to lending, because banks would say, well, you know what, ultimately I can securitize and transfer it, and hence that is kind of a challenge. Also, RBI guidelines provide structured mechanisms for securitization, and the challenges involved are valuation, because the fair value stress securities is a lot more difficult because we don't know the default rates, the collection, etc. And if you overvalue, then loss may be shifted to the investors, undervalued loss will be caused to the banks. So that is a challenge. Regulatory, there's a strict norms relating to, let's say, risk transfer, minimum requirements which are there of holding period. This will be there. There will be moral hazard, market appetite. Investors should have confidence. So securitization is a powerful tool for NPA, but it requires certain regulatory prudence, robust valuation, and long-term stability. You can just review the theory on this. It's a statement. You can write it in your own words. Okay, then you go to question number 4. Now, this is the institute's recent favorite that you see, Sharpe's optimal portfolio, where they use the concept of the cutoff point. Usually, we are required to calculate the cutoff point based on preparing that complex table, the formula for cutoff point, etc. And usually, the highest cutoff point is the cutoff point that you select. In this case, the final cutoff point is given to you. Usually, what do? You take all of these workings, and at each step number 1, you calculate the Trenor ratios, that is the return minus the risk-free rate upon the beta. Step number 2, you rank all the securities using the Trenor ratio. Step number 3 is you calculate the cutoff point, but for that you need to find a lot of data, cumulative values in the numerator, denominator. You do that and you find the cutoff point. And we have studied that cutoff point usually has a bell pattern, that it keeps on going up, reaches a peak, and then it keeps on going down. So that peak that is reached is called as a final cutoff point. In this question, the final cutoff point is given, so you don't need to sit and calculate. There have been people who have calculated and maybe the answers are different, but the question is not asking you only. So if a question gives you the final cutoff point, well, you will take that. Now, what was the inference under the cutoff point? Well, usually the securities up to the final cutoff point will be selected, but here I don't know which all securities are there. So typically we have even discussed this concept, if you remember, in class, where we have said that how do you back test? We say that final cutoff point is a cutoff reward to risk. If your security has a higher reward to risk, that is a higher Trenor ratio than the final cutoff point, your security should be selected. If your security has a lower final reward to risk, that is a lower cutoff point, your security will be rejected. So over here, when you are looking at the cutoff point evaluation, you will look at your securities with, let us say, a relatively higher or a relatively lower cutoff point, and then figure out whether your security should be selected or not. You need to refer that over here. The institute has looked at a lot of inferences in the formula. It really helps that if you kind of focus a bit more on the logic of the formula rather than just by hearting the formula, where, if you remember, in cutoff point, we used to use this more of a cross-checking mechanism, but thankfully, if let's say you applied that, you would be able to get the answer also over here. How do you select how do you finally figure out which securities to select? Sir, if I have calculated a series of cutoff points, wherever the cutoff point is the highest, I will select. But if I don't have a series of cutoff points, in which case I can say that whichever security has a reward to risk ratio which is higher than my final cutoff point is a security I will select. Below that are the securities that I will reject. So if you keep that base over here, you should be able to solve for the next question, which is question number 4. A portfolio manager is analyzing 4 equity shares to construct an optimal risky portfolio using Sharpe's single index model. So this is Sharpe's optimal portfolio. The securities are traded in an efficient market and they follow CAPM assumptions. That is fine. Sharpe is there, so CAPM should be applied. The following information is available. You have the expected return, you have the beta, and the residual variance. This is called as unsystematic risk. Now, honestly, using this data, you can sit and find the cutoff point for each security and do the working. However, if you see additional information, there's a risk-free rate of 6%. Market expected return is 14%. Market variance is given to you as 0.040. So this is given in decimal, so you will take that. And the cutoff rate is 7.95. This is given to you. This is something which is important. This is usually to be calculated, but in this case, if it is given, you will have to accept and take that and solve accordingly. Now you are required to given the cutoff rate. So basically, considering this rate, A lot of students had actually sat and calculated this. It was not required, and maybe your answers may or may not be the same. But if the question tells you given the cutoff rate, you'll have to respect that and solve accordingly. Identify the securities to be included in the optimal portfolio. Okay, how will I identify? Ideally, I should have a series of cutoff points. Here, I don't have that. Well, I try to calculate the reward to risk ratio. So this is return minus the risk-free rate upon the beta. So if I do, this is 17 minus 6 upon 1.4. You will get a reward to risk, let us say, of what? 17 minus 6 upon 1.4 comes to 7.86. 15 minus 6 divided by 1.1, maybe 8.18. 13 minus 6 divided by 0.9, 7.78. And 11 minus 6 divided by 0.6. This is 8.33. Now, what is my final cutoff points? Are 7.95. So, whichever securities have the Turner ratio greater than that, which cross the cutoff, will be selected. So, security A, which has a higher, no. Security B, which has a higher, yes. Security C, no, it is 7.78, and security D, which is a higher. So if I review, let us say, the solution here, I'll calculate the Turner ratio, that is the reward to risk ratio, that is return minus the risk-free rate upon the beta. And wherever I see that my reward to risk is actually greater, like in security B, like in security D, I will accept. Now I can give the ranking if I want to, but here all of that is not needed. I would say that maybe securities B and D are the securities that I will be selecting, and that's about it. If you are able to interpret that, you get your marks. So this is more of an interpretation exercise. If you can see, point number 1, the securities B and D should be selected. Compute the proportion of the investment in each security. Now over here, there was this formula of Z of B that you will have to calculate. Then Z of D that you will have to calculate, which is the beta of B, which is, let's say, 1.1 upon the unsystematic risk, which is, I think, 0.0196 into the reward to risk ratio of B, which you have calculated at 8.18, minus the final cutoff point, which is 7.95. You will do this working to find the Z of B, then you will find the Z of D in a similar fashion, where you will have 0.6 upon whatever is the reward residual. So this is 0.01 into this was what, 8.33 minus 7.95. This is, you deduct the final cutoff point. This was a formula for finding the weights, which was done, I think, in question number 48 or something. This entire situation was there, and you find the two Z values. So over here, you find the Z of D and the Z of B. First, they are doing the Z of D, then they are finding the Z of B. Ultimately, this comes to around 22.8 and 12.91. And once you get this, so this is, let's say, 12.91 for B, 22.8 for D. Now, if I want to find the weights, weight of B is the Z of B, which is 12.91 upon 12.91 plus 22.8. That's about it. So this is 12.91 plus 22.8, 35.71 and 12.91. Maybe this is 0.36 approximately. And the remaining 0.64 should be allocated, let us say, to D. So if I review this, this is for D, this is 0.63 or 64, and this is around 0.36. So this is, let us say, if you review your answers, security D and B should be a part of your optimal portfolio, and you reject security A and C because they have a lower cutoff reward to risk. When you look at this formula for finding the Z, you apply this formula and get 22.8 and 12.91. Based on that, you get around 63.8% or 64% weight given to D, as in Delhi, and 36.2% given to B, that is Bombay. Okay, so that is point 2. Using CAPM, compute the expected return and value of each selected security. So you can do it for all the 4, or selected securities only B and D, you can do it only for these. So what is a big deal? Well, for B, you look at CAPM, that is 6 plus what is the RM, 14 minus 6 into the beta of 1.1. So this is what, 8 into 1.1 plus 6 comes to 14.8. Okay, whereas if I look at D, again this is 6 plus 14 minus 6 into a beta factor of 0.6. So this is 8 into 0.6 plus 6 comes to 10.8. Now if I look at the CAPM return for the selected securities, this is the required return. Your actual return, if you go to C, is 15, which is higher. So B is worth buying. This is 10.8, this is 11, which is higher. So this is worth buying. So, I mean, as an extra working, you can even do it for A and C, and you will find invariably that your CAPM required rate of return for A and C might point that A and C are not worth buying. But if I look at just these two, I will look at the CAPM return. Let's say I think in my solution, I've shown you for reference for all the four. So for B and D, you see 14.8 and 10.8. Compared it with the expected return, we would say that, well, I require 10.8, security gives me 11, it is worth buying. 14.8, 15, well, it is worth buying. Whereas if you look at A and C, which is extra, you can see that A gives you 17.2 required. When A actually gives 17, it is worth selling. C gives you 13, requires 13.2, gives 13, worth selling. And hence the conclusions that you get under CAPM is consistent with the conclusions under the Sharpe's optimal portfolio. That is what they are saying in the fourth point. Why the portfolio constructed using Sharpe's index model is consistent with the CAPM assumptions? Well, because they are based on the same underlying factors. The portfolio using Sharpe's index model is fully consistent with CAPM as it included only the superior risk adjusted returns. So this takes care, let us say, of question number 4, subpoint A. This is Sharpe's optimal portfolio, was asked in Jan 26, has also come in May 26. Now, students who do trend analysis say that, when it came in Jan, they said, it came in Jan, it will not come again in May, it came in May. The amount of time, I again repeat, that you spend in doing trend analysis, if you spend that time in studying what is there in front of you, there's a higher probability of you clearing. Maybe sometimes you go right, sometimes you go wrong, but studying everything, you will almost always go right. Okay, so ensure that you, with the time that you have and the lessons that we have learned, we should try to cover as much as possible. Again, there will always be a fear that how will we tackle such questions. Remember, no matter how much you try to get people's questions banks, that will not be the same that is going to come in the exam. In the exam, maybe something different might come, but if it is different for you, it is different for everyone else. And if you have prepared well, you will see that there will be certain opportunities for you to get your marks, and the institute also gives grace marks. And we don't want to bank on the grace marks, but if you have prepared reasonably well, you would see that people who you looked up to and you said that, well, these are the guys who prepared reasonably well, they have cleared. And hence, have some faith and keep some hope, because a lot of people in the current setup are not very positive or hopeful. And if you lose hope, that is the only thing that we all have. I mean, if you have that hope that, well, I can achieve something, that is what makes you work towards that direction. So ensure that you don't, no matter what, go into that negative side of things and say that, because, well, things will be challenging. And I'll be honest with you, it is not just the CA exam. Even after you qualify, there will be a challenge when it comes to taking a job, getting your desired career, getting that promotion. Maybe developing slowly a mindset that I can do it, and, well, maybe I have to focus on the process. And if you focus on the process, don't take too much pressure on what will come in the exam, what will be my result. Let that job be done by the institute and the examiners. You focus on what you can control, which is your process, and if you do the process properly, you should be able to get your score. So next question, we will proceed further into the calculation. Now, in this question, there was a concept of geometric mean, which was a little tricky for some students, and hence what we'll do is we'll discuss a few statistical measures before we go into this question. These are called as measures of central tendency. This can be arithmetic mean that you have done, that is just a simple average. A geometric mean, which was even tested in this question, something called as a harmonic mean, which we will do additionally, even a median and a mode. So let's quickly discuss each of these measures of central tendency. If I want to calculate, let us say, arithmetic mean, what I will do is, if there are 5 observations, I'll merely add the 5 observations and divide it by 5 will give me the arithmetic mean. But if I want to calculate, let us say, the geometric mean, so So let's say the observations are 10, 15, 20 and 25. Let's say 4 observations. I'll divide it by 4. That'll come to 17.5%. This is called as the arithmetic mean. If nothing is given, that is the default. Okay, second is you have something called as geometric mean, which was specifically asked over here, in which is a very good measure to calculate things like compounded average growth rate, growth rates, etc. are done using geometric mean, though we will not do it unless a question specifically asks us. So what we typically do over here is, let's say if the return is over here, the return over here is, let's say 10%. So we'll take 1 plus R, that is 1 plus 0.1 in the first year, then 1 plus 0.15 in the second year, 1 plus 0.20 in the second year, 1 plus 0.25 in the third year. So that way is 1.1 into 1.15 into 1.1 into 1.25. So that way you are finding the product rather than like arithmetic progression has common difference. You are just adding. Here you are multiplying. Geometric progression is, let's say you are here, there's a geometric mean, so you're multiplying. This is 1.1 into 1.15 into 1.2 into 1.25. So this comes to 1.8975, and this is for 4. So you'll take the fourth root, and fourth root can directly be done by the calculator. I mean, if there's other than fourth root, we'll see what is to be done. You can use the calculator shortcuts for that, square root by 12, etc. But let's say for the conceptual understanding, divide square root it twice. So we'll get around 1.1734, and 17.37% will be around your geometric mean. So this is another way. All you have to do is you have to take 1 plus the return of the first period into 1 plus return of the second period into 1 plus return of the third period into 1 plus return of the fourth period, square root that or root that by the number of observations. So this is 4 observations, so root of 4, or let's say raised to 1 by 4, and you'll get your answer. Now this was asked. Harmonic mean is also a measure of central tendency. It has not been asked. In my opinion, it will not even be asked, but if it does, it is appropriate for taking the average of ratios, like the average P ratio, for example, or the average speed, for example, kilometers per hour, is usually done best using harmonic mean. But from a student perspective, you will not do it unless a question specifically asks you to. So when we are looking at, let us say, an harmonic mean, the formula will be 4 divided by 1. So there are 4 observations, divided by 1 plus 0.1 plus 1 plus 0.15 plus 1 plus 0.20 and so on. So over here, your formula for harmonic mean will be 4. So usually n is in a denominator, here n comes in a numerator, and instead of that, what comes in a numerator, R1, R2, R3, you take 1 by R1, 1 plus R2, 1 by R4 and so on. So you will get this harmonic mean as around 15.58%. Again, usually you don't find the percentage returns or the average of percentage using harmonic mean. It is usually reserved for ratios like a P ratio, speed as kilometers per hour, etc. So these are the 3 numbers, measures of central tendency. Further, there is also something called as a median, something called as a mode. Median is a center observation. It is the observation at the middle. So you sort the data in the ascending order, the observation that comes exactly in the middle. Now, when you look at 5 series observation, the third observation in the ascending order will be the median. But if it's a 4 series observation, the observation between 2 and 3. So you will take the average of the second and the third observation, that will give you the median. And mode is the observation that repeats the maximum number of times. It is possible that your data might not have a mode because everything might come only once. But these are the measures of central tendency in case something like this kind of comes up. So if I take that background and go to subpoint B, and also there is one more thing. Well, when you look at an open-ended fund, the fund is ready to issue new units or redeem whenever the investor wants. So whenever the investor needs, they can go to the fund in case of an open-ended fund. But when it comes to a closed-ended fund, usually the fund will not really claim redemption or issue new units. However, if an investor wants, they can buy or sell in the market. The fund will publish the NAV. However, the fund will not be open to redemptions or new issues. And as a result, when I'm looking at, for example, the NAV over here, the NAV in case of a open-ended fund will be the base for an investor, but for a closed-ended fund, the market price should be the base. The market price theoretically should be the same as NAV, but it is a function of demand and supply, and hence there can be some premium. That is, your market price can be higher than NAV if that unit is in high demand. There are more buyers than sellers, or the NAV can also be at a discount if that unit is, for example, at a that unit is, let us say, at a let's say lower. For example, that unit is, let us say, at a lower value. So when I'm looking at, let us say, the NAVs, it can be at a premium, the market price can be at a premium or discount, and maybe for a close-ended fund, the return can be calculated based on the market performance also quite well. So if I look at, let us say, the recent performance, point B, for a close-ended fund, it is clearly given to be a close-ended fund. So there's a period where there's an NAV, and then there's a premium. Premium will be added, discount will be subtracted, discount will typically be minus, premium will be plus. So this is NAV. Now if I look at the market price, there's no premium, so this will be 20 only, and this is 20, this is premium or discount percentage, not in rupees. So 22.5 minus 5% will come to 21.375. Then you have 19.5 plus 2.3% comes to 19 point. Well, let's see how many decimals. Let's say you take 2 decimals only. So let's say this is 21.38. Can be taken more decimals as well. So this is, let's say, 19.5 and 2.3%. Then you have 21 minus 3.2%. This is 20.33. And 22.3 plus 4% will come to 23.19. So these are the market prices which are there. Okay. Next, what do we have? You are required to evaluate the average return per period based on geometric mean. So this is based on the geometric mean. So you have to take the average return per period. So you'll have to find a return for the period first. For the investor who bought 1000 units of this fund when at the invitation and sold her position at the end of the 4th year. So over here, if I want to find a return, I will take the return based on, let us say, the market price. So over here, if I want to find a return for the first year, I will say in percentage, this is P1 minus P0. So this is 21.38 minus 20. So this comes to what? 21.38 minus 20 upon 20 into 100. This comes to, I think, 6.9%. Then 19.95 minus 21.38 upon 21.38 in percentage, negative 6.69%. Then you have 20.33 minus 19.95 upon 19.95. This is 1.90% positive. And 23.19 minus 20.33 upon 20.33 in percentage is around 14.07%, let us say. So this will be your percentage return, and they're saying evaluate the average return per period for an investor who bought 1000 units in a close-ended fund and then sold her position. Now the question is, when they sell the position, see at the beginning, whether you take the NAV or whether you take the market price, it is one and the same. But over here, we have to figure out whether in this particular case, should you calculate return based on NAV or based on market price? I would say based on market price, because for a close-ended fund, if I want to actually sell in the market, I would have sold at 23.19. And you have been asked to calculate a return using geometric mean. If I had to find using arithmetic mean, this is 1, 2, 3, 4 divided by 4, end of story. The problem came because of the geometric mean, and if I had to do using geometric mean, you'll use similar principles. So over here, if I review, first of all, you first find the market price, 21.38, 19.95, 20.33, 23.19, and then the returns, 6.9, 6.69, 1.9, 14.07, one and the same. Now, if I were to formulate the equation, let us say if I were to write the equation somewhere, for the geometric mean. So if I am able to get that equation correct, I should be, so this is 1 plus r raised to 4 will come to, let us say this is your CAGR, r is your geometric mean or compounded average annual growth rate. This is 1 plus 0.069 into 1 minus 0.0669 into 1 plus 0.0190 into 1 plus 0.1407. So if I review this, this is 1.069 into 1.0190 into 1.1407 into, what is this? This is probably 1 minus 0.0669. So this should be into 0.9331 if I am not wrong, maybe. So this is 0.9331. So this comes to, I think, around 1.1594. Now this is 1 plus r raised to 4. Now if I want to find the 1 plus r, this will be, let's say, 1.1594 0.1594 raised to 1 by 4, or the fourth root. So this is 1 and 2. So this is 1 plus r equals 1.0376 or 77, and hence R over here equals 3.77%. This is your R. Now, honestly, this is a slightly longer way, but this is a foolproof way. A shortcut is also possible where, as a shortcut, you can directly take the ending value and the starting value, and you can still get the same answer. Like you can take, ultimately I started at 20, I reached at 23.19. So what is the return that I'm generating? I can take that return and take the fourth root, you will still get the same answer ultimately. But let us say if I were to review in this particular case, ultimately do I get 3.771%? Yes, whatever method, either I take these values or I take these returns. When you are multiplying each of these numbers, I would take the longest method, and that will be preferably the method that we will solve. So over here, if I take the return for the geometric mean purpose, this will be, let's say, coming to 1.0377 or 3.77%. A shortcut can be, you can directly say that 20 becomes 23.19. Geometric mean is nothing but a compounded annual average growth rate, CAGR, and hence over here, if 20 becomes 23.19, then your R is 3.77. That is possible in the first as well as in the second subpart. Okay, so this is subpoint 1 in point B. Then look at subpoint 2, geometric growth rate of NAV over the same period, and interpret the results. Now you can do it by the longer method where you can find the return of the NAV as well. So this is 22.5 minus 20 upon 20. So this is maybe 12.5%. Then this is 19.5 minus 22.5 upon 22.5 in percentage. This is around 13.33% negative. Then this is 21 minus 19.5. This is, I think, 1.5 divided by 19.5 comes to 7.69%. And lastly, this is 20. So this is 1.3 upon 21. This is coming to 6.19%. So one option is you take these numbers and you have the same formula construct over here, or you can take directly 22.3 upon 20 and you get, let's say, that same working. So if I look at the NAV calculation in the second subpart, you have these same workings, 12.15, 13.33, 7.69, 6.19, and you make that in the same formula and you get around 2.76%. Shortcut will be to compare 22.3 with 20 and find the answer as 2.76. Now, as you can see, the return under the market price is higher than the return under the NAV, because over here at the end your market price is at a premium. You started with market price and NAV being the same, but at the end the market price comes at a premium, and hence if they had asked you, I'm not sure whether they're asking, and interpret the results, yes. So the reason over here is because the market price is at a premium. So at the end, if I go to see the growth rate in NAV is lower than the return percentage, because the market price has increased more than the NAV. So market price at the end is at a premium, and that is why your answer. So we have also tried to discuss harmonic mean, geometric mean, alternative methods so that you can solve. Now, when you look at this point C, there are two parts. One is a theory, which is Elliot wave theory of technical analysis, where you have Mr. Elliot, who way back in the 1930s tried to study the patterns in the market, and he said that the patterns in the market can be, you can try to have waves. So he says that there is a wave like this, where this is the impulsive wave. So this is 1, 2, and 3. Let's say this is the impulse wave. This shows the direction of the market, which is going up, whereas this is a correction wave. So this is usually an upward movement. This can also be a downward movement where it is going down, then up, then again down, then up, and then down. So when I'm looking at again the Elliot wave, I'm saying that the direction primarily is a downward direction. But let's say there is a correction that is coming, which is going up. So there are two types of movements. In case of an Elliot wave, if I look at the theory, there is something called as an impulsive movement. So this was made by Ralph Elliot in 1934, and he defines these movements into impulsive patterns and corrective patterns. Impulsive patterns are the basic waves. These are the three waves that are going up. For example, in our working, it may be in blue this upward, and the red two waves are the correction waves. So impulsive waves in this pattern, let's say the three waves in a given direction that is going upward or onward, these waves shall show the direction of the basic movement. This is a basic movement. This can indicate a bull phase, like it's upward, so it is indicating a bull phase, or a bear phase if it is downward. But the corrective pattern, for example, are the reaction waves. These are against the basic pattern of the movement. Correction waves correct the earlier rise in a bull market or fall in case of a bear market. So they kind of together, these waves can show a particular pattern, and that is regarding the Elliott wave theory. This is a relatively manageable, I would say. Most of you would have read, at least from the theory section, compiler, etc., pertaining to the Elliott waves. I think most of the students would have attempted this, because the second question is a numerical one, but it is an incorrect one. So, and in this paper there are multiple places where there have been a few errors as well. In this question, there are a couple of open points, and hence, I mean, it does not definitely deserve 4 marks. It's a much more longer question, but thankfully it came as a theory optional, and we'll see what is to be done in this question. And to be honest, you don't have adequate data. It is not a correct and a complete solution as well. We have checked this, and you can even check it online, maybe use AI, but the answers will not properly match up. We'll just review it in any case. So let us look at question number 4C, the second option. This is on interest rate collar. Now, when you look at, let us say, a cap, when you look at a floor, what is a cap? A cap is a protection that a borrower takes from rising interest rates, whereas a floor is a protection that a lender takes from a falling interest rate. So usually, if I'm a borrower only, I should buy the cap. That is it, end of story. But does a cap come free of cost? No, sir. We'll have to pay some premium. Okay. Similarly, over here, I want some protection against rising interest rates. However, I don't like paying the premium. So what do I do? In such a case, I enter into something what is a collar strategy. So if I'm a borrower, I will buy the cap, but I will sell the floor as well. So my net premium that I will pay will be the premium that I pay on the cap minus the premium that I receive from the floor. Sometimes I'll try to create what is called as a zero cost collar, which means the premium that I pay on the cap will equal to the premium that I receive from the floor, in which case my cost ultimately comes to be zero. I'll have two options in such a case. I'm an option holder for the cap and an option writer for the floor. Now, what is the premium, or how do you find the premium? Now, the value of any asset or any item in the world of finance is the present value of future cash flows. So you will try to figure out that how much is the premium that I should pay on the cap. Well, I will say that, well, I'll try to find the possible cap payoffs. Well, there may be multiple dates. On each of these dates, I'll figure out whether there is going to be a payoff, and I'll try to find the present value of these cap payoffs, and that will give you, let us say, the total value of the premium that I will pay on the cap. Logically, if I can find the value of any asset, whether it is equity share, bond, options, it is present value of future cash flows. Now, if I can find the premium of the cap and it's a zero cost collar, that will be equal to the premium on the floor. So you can try to build that analogy, build that bridge. Until that point, I think this question kind of makes sense. Beyond that, there's a bit of a problem. Let us review this once. Now, ABC has a 100 crore floating rate loan, and it resets annually for 4 years. Okay. It enters into a collar strategy to hedge against interest rate risk. The cap rate is 9.5%. Okay, so this is the cap strike price, which is given as 9.5%. Again, ABC has 100 crore floating rate loan. It is resetting annually for a period of 4 years, and it enters into a collar strategy. Collar strategy is, let's say, it has a floating rate loan, and if it has a floating rate loan, it is like a borrower. So in case of a collar, you will ideally buy the cap, but at the same time you will sell the floor to hedge against the interest rate risk. The cap rate is 9.5%. Expected interest rates and discount factors are given to you. So you have the expected rate and the discount factors. You are required to identify a floor rate that makes the cost makes the collar a zero cost collar. Ignore volatility. So what is asked over here? You are asked to identify the floor rate that makes the cost a zero cost collar. So what is the floor rate? Maybe this is the floor exercise price. Floor rate can also be the floor premium, and if it is a floor premium, then perfect. We will be able to calculate. But the floor exercise price requires a bit of ambiguity over here. Let us see what has to be done over here. Now, when I look at the cap rate, I clearly have the cap rate at 9.5%, and you have been given the expected rate as 7.8, 8.6, 9.2, and 10.6. Now, when will the cap be exercised? So, if I look at the cap will only be exercised if your actual, let's say whatever this is, LIBOR, SOFR, whatever it is, if this rate is greater than the cap rate. So at 7.8, the cap will not be exercised. At 8.6 also the cap will not be exercised. Remember, the cap is a cap on the interest rate. So if your interest rate exceeds 9.5, then there'll be a payoff that you will get under the cap. However, the rate is 8.6, then the cap will not be exercised. Even the rate is 9.2, the cap will not exercise. The only place where the cap will be exercised will be when the rate is 10.6. And hence the cap payoff, if I were to calculate for a holder, based on the expected rates, the cap payoff will be 0 over here, will be 0 over here, will be 0 over here. But at the last instant, there would be some cap payoff. So what will be the cap payoff, sir? This will be 10.6 minus 9.5 into, for example, 100. So this comes to 100 into, let us say this is 1.1. So 100 into 1.1% comes to, let's say, 1.1 crore. So ideally, when I look at the value of a cap, the value of a cap is the present value of the future payoffs or the cash flows that the cap generates. The cap will generate 0 cash flows in the first 3 years, but it will generate 1.1 cash flow in the 4th year. Now, in today's terms, remember the premium has to be paid today. The premium is the present value of the future cash flow. This is 0 for the first year, 0 for the second year, 0 for the third year, and 1.1 crores for the 4th year, which is into 0.84, and hence 1.1 into 0.84 comes to around 0.924. So ideally, in an efficient market, if I were to pay the premium for a cap, I would say that I would be ready to pay 0.924 as a premium for the cap, because ideally the value of any asset, including a cap, for example, it is also an option, is the present value of the future cash flows. So you'll try to predict the future cash flows that the cap can get. Well, the cap can get 0 cash flows in the first 3 years, but a 1.1 crore cash flow in the 4th year, which in today's terms comes to around 0.924. Now, if it is a collar, rather it is a zero cost collar. A zero cost collar would mean that the premium on the cap will equal to the premium on the floor. So the cap premium of 0.924 will also be equal to the premium on the floor. So ideally, if they just wanted to find the premium or the rate of the floor, in my opinion, the question should have stopped over here. Ideally, we should have stopped at this stage and we would have got a logical answer. So over here, if I review, I would say at the beginning, a few reference notes, that ABC is a borrower and hence to hedge, we should buy the cap. However, since the strategy is, collar strategy is done, additionally, we will also have to sell the floor, but what is the exercise price? We don't know. The value of any asset, even an option, will be based on the present value of future cash flows, that is the payoff that it generates. So the value that is premium should be based on the payoff for the cap. So that will be around 0.924 because it is a zero cost collar. The premium that is paid on the cap will be equal to the premium that is received on the floor, and hence this will be equal to 0.924. Okay, this is where, in my opinion, the question should have ended. They should have just asked you to calculate the premium on the floor, and that's it. It is perfect for a 4-mark question. Now they are asking you to find the exercise price. Now the problem over here is we don't know the exercise price. Now one can say you can assume any exercise price. However, the institute, the way they have solved is they have in a way implicitly taken the exercise price to be 9.5 even for a floor. I mean, it could have been different as well, but they have taken implicitly 9.5. Now, in my opinion, that is not correct because then you are assuming the answer. But again, my opinion matters less. The institute's opinion matters more. So what they have done is they have implicitly taken the exercise price as 9.5 and tried to find the payoff under the cap. So over here, if the exercise price was exercise rate was 9.5, then when will the cap be exercised? When will the floor be exercised? So if, let's say, for the floor, the exercise was at 9.5, then floor is going to be exercised when the rate is lower. So if your rate is 7.8, the floor will be exercised. 8.6, the floor will be exercised. At 9.2, the floor will be exercised, but at 10.6, the floor will not be exercised because the lender will be happy to get 10.6 instead of 9.5. In all other cases, the floor will be exercised. So let the floor exercise rate, for example, over here, they are taking that 1, 2, and 3. These are the 3 possibilities that the floor will be exercised. Now, why is it necessary to, in a way, implicitly assume the floor rate? Because if you don't do that, how will you figure out when the exercise will happen? You will go on in loops and in circles, because I mean, you can say let the floor rate be x. Or if you take the floor rate as x and solve, there is a possibility that if that x is around 8.5, then this will be exercised, all the others will not be exercised. If it is 7.5, none of these are exercised. If it is, let's say 11.5, none will be exercised. So we don't know, and hence we will have to take a notional value, and which institute does not write it clearly. But I believe institute has taken 9.5, which is the same as the cap rate, because that is the only way where they have taken the valuation considering these three. So they have said that, okay, the premium I know is 0.924. Let's say the exercise will happen in the first three cases. How do I know that? Well, I don't know. Honestly, if you know better, I would be very happy if you give me the answer in the chat. And you can always ask Chat GPT or Claude, whatever it is. But in my opinion, it is not properly done. In a normal course, the floor strike rate needs to be lower than or equal to the cap strike rate. Okay, that's an assumption. Let's say, so we are taking the 9.5%. Say the floor strike rate was 9.5%, then the floor exercise would happen in the first, second and third case, but it will not happen in the fourth case. And hence, if I were to formulate an equation, I would say that the premium today is the present value of the future payoffs. So the payoff over here would be, for example, if the floor gets exercised in year 1, 2 and 3, then there would be payoff in years 1, 2 and 3. The value of a floor, that is a premium, would be the present value of the floor payoff. That is the zero cost collar. This cost would be 0.924. But what will be the payoff? Well, actually, I have just assumed the rate to be 9.5. That is like saying assuming the answer. I have to find the strike price. So what they do is they prepare this working. I mean, I'm doing it in a tabular form. They've done it in an equation form. You can consider the discounted, ignore the discounted. In my opinion, you should consider the discounted. So over here, year 1, 2 and 3, the payoff over here would be 9.5 minus 7.8, that comes to around, so if I do 9.5 minus 7.8, that comes to a particular value 1.7. But then there is no use doing that. If I take 9.5, I'm assuming the answer, in which case there's no use doing this. So over here, I would take, let's say, the final floor rate to be F, and I will say F minus 0.078. Institute has given you two answers. One is if I take 7.8, one is if I take 0.078. Ideally, 7.8% is 0.078. So I would do by this method into 100 crores, but this is a payoff that we will get in the first year, into 0.96. F minus 0.086, it is going to be exercised into 100 crores, but this is in the second year. F minus 0.092, I am saying that even in the third year there will be an exercise, and hence into 100 into 0.88. So these will give you the three different cash flows. In the fourth year there is no exercise, and hence this was kept at 0. So this is 0.924. Now if I were to formulate this as an equation here, considering discount factor, that is more appropriate. If I formulate this as an equation, the premium will be the present value of all of these cash flows which are there in the table, and hence the F comes to 8.85% ultimately. Now, in my opinion, that is wrong, because this is again not the final answer, because if you take it as 8.85, there is going to be no exercise in the third case. So inherently the institute permits you to take 8.85 as one of the answers, but it stops over there. In my opinion, for a 4-mark question, they should have stopped at premium on the floor, or they could have given a range where the floor is within this range. So you know which are going to be exercised. If they tell you that the floor is between, for example, 9.2 and 10.6, then I know that, okay, the first three cases are going to be exercised. If they say that the floor is going to be between 8.6 and 9.2, then I know that the first two are going to be exercised. But if they don't give me a range, and for a 4-mark question, this will keep on going in circles and loops. They have ended over here, but in my opinion, that is not correct. ICI has kept the answer as 8.85%, but ideally if the rate is 8.85, there would be no exercise at 9.2%, and hence this is not proper. But well, it is what it is, and hence there are some grace marks as well. In fact, you will see one of the MCQs that you will do in some time where they will say there's no correct option only. So I don't know, this paper was intended to be made to be a very deep conceptual paper. It is a well thought of move, 100%. It is not a random move. It is well thought of, deliberated move that we want to have this paper to be a very deep conceptual paper for whatever reasons. However, this has not been properly executed. You can always fall back and say that I will give grace marks, but imagine the number. I mean, you should also give grace time to a student, right? When a student is writing the paper of 3 hours, and the student is going in these circles and circles and is unable to figure out, because I can vouch for the fact that a student, when he reads this question, will not have a confidence to say that this question is wrong. unfortunately or fortunately, I mean, if I was a student in your place, when I am sitting and solving, there is no way that I can say that the question was formulated wrongly. I will always doubt my own self that what did I do wrong, and that will have a spillover effect not just in this question, in other questions as well. So, well, if you want to give a conceptually deep paper, well, do give, but at least I would have a humble request to the institute that get it better proofread, because um, uh, it really costs to the student emotionally, uh, physically while writing the paper, mentally everywhere. So if you don't know, you don't know. But if you're going in circles, people would have gone round and round. They would have said, oh, 8.85. A person would have thought that at 8.85, this cannot happen. But it is what it is. So over here, if you see the solution, they have given you this entire solution. Till this point, I would say that this kind of works properly. Over here, just a second. So this is total value of the cap is the present value of the cap payoff, which is 0.924, which is also the floor value. So they are saying that these are the three places where the floor will be exercised. I don't know how. Maybe that is based on an implicit assumption of the cap rate being taken as the same, because otherwise how can you say that these are the three values and the fourth value will not be exercised? I can always argue and say the third value will also not be exercised. Then they have taken this equation and they have found the answer ultimately as, I mean, with percentage sign or otherwise, 8.85 is one of the accepted answers. But I don't think that this is a appropriate question. So even if you had attempted, at the end, you might have been given certain grace marks, is my at least hope and expectation. So that takes care of question number 4C. Next, you will go to question number 5. The paper is still going on. Imagine we are just discussing this paper and it is close to around 2 hours. You have to complete, write, solve this paper in a matter of 3 hours. It is a big challenge, honestly. So over here, let's review question number 5. A momentum driven investment consultant is pitching Lumina Cloud Systems to your client. The consultant claims that this is a bargain because the cash flow from operations, when capitalized at the prime lending rate of 9%, yields a value of 425. So he's using a method to value the share as cash flow from operations divided by, let's say, a prime lending rate. LCS is currently trading at around 240 per share. So this is your market price. Now you will use your own valuation techniques. You are required to perform a two-stage FCFE valuation to verify these claims. So you've clearly been told to do it, take free cash flow to equity. So the financial data and assumptions over here is net income in the base year is 180 crores. And in the high growth stage, which is for the first 2 years, net income will grow by 25% annually. So this is 180 plus 25% will come to probably 225 in year 1. And in year 2, another 25% will come to 281.25. So this is your net income in the high growth phase. The net investment in operating assets is projected to be around 240 crores in year 1. This is the net investment, and 280 crores in year 2. Okay, so this is your net investment. Note this represents capex less depreciation plus increase in working capital. That is brilliant. When I look at the free cash flow to equity, what do I need to do? When I look at FCFE, I will usually start with the PAT. This is after interest plus add back depreciation. Minus, I will, let's say, subtract capex or increase in fixed, and minus increase in working capital. Yes, there will be plus or minus debt as well, let's say debt taken or repayment, but they are saying that this value, this entire value, like the net investment in operating assets is 240 and 280. This is capital expenditure less depreciation plus increase in working capital. So this is capex, working capital and net of depreciation. So you have been given the entire 240 and 280 crores is the value for these terms. Okay. The debt policy of the company is it's financing 30% of its net investment in operating assets through new debt. So basically whatever this number comes, I would say that in this case, I'll not plus or minus debt. I will just say that this number 30% is debt. I'm trying to find FCFE. So 1 minus 30%, that is 0.7 will come from equity. So PAT is purely belonging to the equity only, so I don't need to do any debt adjustment for that. However, this net investment in operating assets, you'll have to do, let us say, some debt adjustment. Okay, the cost of equity, the risk-free rate is 6%, the company's beta is 1.2, and the equity risk premium is 5%. They've interpreted this to be market risk premium, that is the risk premium to invest in equity shares. So this is 6 plus 5 into, let us say, 1.2. So basically, I think 12% will be your cost of equity. stable stage, that is third year onwards, the net investment in operating assets will drop to 20% of the net income in each year. So whatever is the net income in each of the years, net investment will directly drop to 20% of that. So they are solving it in a particular way. Again, there's a small inconsistency over here. So let us review that. And the outstanding shares are 60 crores. You have been given the present value factors at year 1, 2 and 3, and that is at 12%. So we have, let's say, the 12% value. KE, remember FCFE is to be discounted at KE. You might always say that I can sit and find a WACC. You don't need to go into that tangent because you are taking FCFE, and FCFE discounted at KE will give you the value of equity. You are required to find the total present value of the FCFE for the high growth period, that is just stage 1. So you just want to do stage 1, that should be easy. I would say that this is 281.25 minus this is, let's say, 240. Oh, not 240, this is 240 into 1 minus D. So if I were to review, just a second, I would say in year 1, I would say this is 225 PAT. Year 2, this is around 281.25. So this is just for the high growth phase, minus the net 240, but 240 is the total investment of everything. Out of this, something will come in debt, the remaining will be equity. So this is minus 280 into 1 minus 0.3, and hence this will come to what? So this is, let us say, 240 into 0.7, and this is 225. So this comes to, let's say, 57, and this is what? 280 into 0.7, and you have 281.25. So this comes to, I think, 85.25. And if I discount this at the rate of 12%, this is 0.893, 0.797. I should ideally get the values that I am looking for. So 57 into 0.893 and 85.25 into 0.797, and this comes to around 118.85. Approximately, subjected to certain degree of rounding off differences. So over here, if I look at this particular value, ultimately this will come to 118.85. This is the answer to the first part. Okay, so these are relatively easy marks, I would say, for a change in this paper. Second, if the current market price of 240 is considered to be fair by the market, calculate the implied sustainable growth rate for the terminal stage, that is year 3 onwards. So they have not given you the year 3 growth rate. So ideally what I will do is, well, 240, if this is considered to be fair, so this is 240 per share. You can even take it for all the shares. If I want to find a value for all the equities, so this is 240 into 60 will come to probably value of equity. 240 into 60 will come to around 14,400. Now I would say that 14,400 is nothing but the present value of the future cash flows. Well, that is 118.85 in the high growth phase, and then in the stable growth phase. Now if I want to find a stable growth phase, I'll have to somehow find the cash flows over here. So we will say, well, you know what, over here, if everything else remained the same as well, like this 281.25 also remained the same. As a matter of fact, it can grow, but let us say it assumes it remains the same, then my FCFE is not the same. My FCFE is after deducting, let us say, your net investment in assets, and let's say that is 281.25 into 20%, it is dropping, so that is 56.25 into, let us say, 0.7 again, which is 39.375. So when I look at year 3, I don't know what the year 3 PAT is, but let's say even if that PAT was remaining the same, I would say that this will be 281.25 into 20%. That will be your net capex. But this is from total, you have to find your own funds, and hence this is 39.375. So at the steady stage, even if there was no growth, as a matter of fact, there will be growth, that is what you have to find, but even if there was no growth, this would be 39.375 and 281.25. So this would be 241.875 before growth for the third year. So had there been no growth, at 0% growth, this would have been the position. But as a matter of fact, there could be certain growth. Let's say the growth rate is G. So I would take 241.875 in my calculation. 241.875 into 1 plus G. I don't know what that G is, upon KE, which is still 12% minus G. and this will be the value that I will get. Let's say so this will give me the third year's cash flows upon 12 minus G. This will give you the value at the end of the second year into point, I think what, 797 if I'm not wrong. This is the value at the end of the second year, 0.797, and that's about it. Now it is just a mathematical calculation. 14,400 minus 118.85 comes to around 14,281.15 equals, well, this is, I mean, you can expand this equation and see. So over here, this is 12%. This is the working that you do, and you get 241.875 into 1 plus G. This is in line with what the ICI solution is, into 0.797. And then, I mean, you can sit and solve the equation. There's only one missing variable. So you can take 0.797 on the other side. You can keep on solving, and G comes to around 10.51%. This is a solution which is accepted by the institute. So over here, to start with, so this is, let us say, not really year 3 value. I would say that this is, let's say, year 3 value assuming no growth, but as a matter of fact there is growth. Assuming no growth, but as a matter of fact there is growth. So we will say that even if there was no growth, then the value would have been 241.875. with the growth, this will be into 1 plus G, and you will solve it and get 10.51%, which is what even the institute has solved and found in one of its working. There's an alternative presentation. Almost every sum has alternative solution, but it is more than sufficient that we understand, let's say, the more logical one or the clear one. So that is your first solution. Then you go to sub point B. Now this is a question which kind of took almost everyone by surprise. The question, when you read it with a clear mind, is very common sense driven, but I'm telling you, in those 3 hours it is impossible. You will always keep on searching, where was this, where was this, where was this. It was a very generic question, and this is a question which is based on a relatively a bit of common sense. Some students could crack it, some students kind of got lost. I would have gotten lost in this question because this had a lot of new terms, and I would say that this is something which, the question that we will see over here, this is on gap exposure. The gap over here is the gap between rate sensitive assets and rate sensitive liabilities. So you might have someone like a bank. Now the bank, what it does is it can borrow money. Let's say again, this may be at floating rate. It can even lend money, let's say at floating rate, in which case a bank has a borrowing which is interest rate sensitive. It also has an asset which is interest rate sensitive. So the gap over here is a gap between the bank's borrowing. Let's say it has done a 10,000 crore borrowing and it has given a 11,000 loan, for example. So there is a positive gap. The assets are greater than the liability. 11,000 minus 10,000, that's a positive 1,000 gap. On the other hand, if let us say the bank has borrowed 10,000 but given a loan of only 9,000, then there is a negative gap. There's a net liability of, let's say, net 1,000. So this is a negative gap. So when I look at a gap exposure, the gap is between the rate sensitive assets and rate sensitive liabilities. Now sometimes they might say that, now if the market rate of interest changes and rate sensitive assets, which means these are typically floating rate assets and floating rate liabilities, typically when the market rate of interest changes, if let's say your market rate of interest increases, now you have a net liability exposure. That means you will have to net pay more. So that is a loss for you, and that will reduce your net interest income. However, if let's say the interest rate reduces and you have a net liability, so there is a lot of permutations, but it is all common sense driven. You will say that, okay, I have net liabilities, net borrowings, which means I have to pay net interest, and if the interest rate goes up, that is a net cost for me. But if the interest rate goes down, that is a net gain for me relatively, and hence my profits should ideally increase, because if the interest rate is going down and I have a net liability, that is a net gain for me. The exact opposite will work if there's a net asset. It's a positive gap where I have 11,000 of assets, 10,000 of liabilities. So I have net assets of 1,000, and if the interest rate goes up on my interest sensitive, that is floating rate assets, I'll get more interest on a net basis, and that will increase my income. But if there is a reduction in interest rate and I have a positive gap, I will have, let us say, a reduction in my net income, and that is about it. There is also another concept of earning at risk, where you are trying to say that, well, how much of your earnings are at risk based on certain specified thresholds. So this is definitely a question which is very unique, very different, and no matter how much you would have referred from wherever you would have referred, this is a question which would have hit you for the first time when you see this. Okay, so let us review question number 5b. So Zenith Commercial Bank Alco, bank's Alco, that is asset liability division probably, is evaluating the repricing risk for 0 to 90-day time bucket. So maybe certain loans within 0 to 90-day time bucket. Following is a quarterly data. Remember, this is a quarterly data which is available. The rate sensitive assets, these are rate sensitive, which means these are probably floating rate, are 12,500, and the rate sensitive liabilities are 15,800, which means there is a net liability of 15,800 minus 12,500. This comes to 3,300. This is a net liability. This is called as a negative gap. Your liability is greater, so the gap over here is called as a negative gap. Okay, the quarterly net interest income, this is net interest income. So there will be certain assets which will give me income and liabilities. Sir, but how is there an income? My liability is more. Well, if you're aware, you might borrow at a lower rate. What does the bank do? It borrows at a lower rate. When bank borrows or takes FD from you, it will borrow at a lower rate, but will give out loans at a relatively higher rate. So there is a possibility you can still have a quarterly net interest income of around 450 crores. Now, what is the risk policy? The bank's earning at risk limit is 8% of the quarterly net interest income. So you are worried that if there is a volatility of more than 8%, so this is 450 crores into 8%, that is 36 crores. You can do the working even directly. So this is 450 into 8%, that is equal to 36 crores. So if the volatility is more than 36 crores, then what? Then hedging is mandatory if the potential NII impact in any scenario exceeds this threshold. So if your impact on the NII, whether positive or negative, it is exceeding 36 crores, that is 8% over here, then hedging is a must. You are required to identify the gap position, that is either positive or negative. So the gap position is 3,300 and it is a negative position. And determine which of the following scenarios is favorable for the bank's net interest income, providing a brief justification. Well, the repo rate increases by 50 bips, that is 0.5%. The repo rate increases. Remember, you have a net liability. If you have a net liability position on this 3,300 net liability, you have a net liability and the interest rate is increasing by 0.5%. That will increase your cost. 3,300 into 0.5%. So this will be 16.5, if I'm not wrong, reduction in the overall position, because yes, maybe your liability is 15,800, but your assets are also 1,200. So if the rate increases, it increases for the assets also, liabilities also. But beyond 12,500, for the additional 3,300, it is just a liability, and hence if the rate goes up by 0.5%, that would result in a 16.5 loss for us. It is still within the threshold of 36, and hence you might not need separate hedging, but there will be a reduction in net interest income by 16.5. Okay, repo rate decreases by 25 basis points. So there's a decrease by 25 basis points and it is a liability. So negative 3,300, and the interest rate is also decreasing by 0.25%. Now that is good for you. 3,300 into 0.25%, you are a net borrower. So this is a positive 8.25 gain. So, I mean, if you go to see, this is common sense. However, that is acceptably and rightly so. You don't have to punish yourself that, Array, I did not even think about this. Well, when you see a question and we have to shortlist, you will say that this is a question I don't know only, let me try something else. That is what people would have usually done. Then you have calculate the earnings at risk in rupees crores as a percentage and as a percentage of NII for both scenarios. So earning at risk in rupees crores is, I would say, 16.5 in the first case upon 450. And maybe 8.25 in the second case upon 450. So if I had to take the percentage, 16.5 upon 850 in percentage comes to around 1.94%. It is significantly lower than your 8%, and 8.25 divided by 450 comes to around 8.25 divided by 450 comes to around 1.83. Just a second, I'll have to probably do this again. 16.5 divided by 450, is that correctly done? 3.67%. So over here, this is probably 3.67%. Okay, so that is about it. Based on the bank's risk policy, advise whether the management should activate hedging strategy or not. Well, not needed, because it is lower than your threshold of 8% or in percentage or 36 crore in rupees. So when I look at, let us say this question, the gap analysis is the difference between assets and liabilities. So this is a 3,300 net negative gap. The impact on NII would be 4.125. Since we have more liabilities, higher interest will result in higher expense. Did we get? Oh, my bad. I missed something fundamental. I'm sorry. Over here, we have to take quarterly. These are rates of interest which are per annum. I missed that. And I mean, this is on a per annum basis. 0.5%, 0.25%. These are repo rates are quoted as percentage per annum number. And we are asking to show the impact of quarterly net income. Take our life only. Don't leave anything institute. Over here already we are trying to do all of this, and here there's a quarterly income exposure. So this is 16.5 into 3 by 12. That will be 4.125. Sorry. Sir, would you have cleared this paper? I don't think so. Over here, this is 3,300 into 0.25%. This is 8.25 into 3 by 12. This comes to, let's say, 2.0625. So this is 2.0625. And now you can probably take the workings. We missed this. So this is something that you will remember if you're listening to this video. This you will not forget. Sir, I made a mistake over here. You know, it is fine if we make a mistake. No, it is not fine. I want my students to be better than me. So over here, this is, that's a good way to cover up your mistake. Huh? So over here, when we look at, let us say, this working, we will say that, okay, this is into 3 by 12 because it is a quarterly, and this is again into 3 by 12, this is quarterly. So there's a 2.06 and a 4.125. And if I, let's say, 4.125 divided by 450 comes to a 0.92%. That is hardly any exposure. So this is 0.92%. This is definitely not requiring any kind of separate hedging. This is 0.92%. This is 4.125 and 2.06. So this is around 0.46% or something. And hence, as we will conclude, that you don't need any separate hedging. So this is 0.92, 0.46. Bank's threshold for activating hedging is 8% or 36 crores. Since the EAR is earnings at risk is lower, no hedging is needed. Since EAR is lower, no hedging is needed over here. We can verify this in our solution as well, where we look at, let us say, the gap calculation is 3,300 negative. In the first case, there's an unfavorable scenario, and this will result in 4.125 with this adjustment. In the second case, it's a favorable scenario where it will result in a gain in a way of 2.0625 or something, and that's a 0.46 or 45%. Since the value is positive in any case, there's no need for hedging. Okay, the third part now. Theory was, let's say, a savior, I would say, in this paper, and hence we always say that we should focus also on theory. A lot of students rightly so focus most on practical, but that does not mean you ignore the theory altogether. In papers like this, theory will be acting as a savior, and if you have not yet done, I would strongly recommend that you can view the theory compiler that we share on Telegram before every exam, which is updated, and we have the video for that on YouTube as well. So in case you have less time, at least refer that and you'll have a fairly good idea, because in bad papers of practical, theory can act as your savior. Like you see this question, briefly justify the why transaction exposure is generally considered to be more critical than translation exposure from a financial risk management perspective. It is just 2 marks. So what you have to write over here is transaction exposure. What is that? That is on actual exports, actual imports, and on that, if there is an exposure that is going to result result in a real gain or loss. But what is a translation exposure? That is on converting your subsidiary's trial balance into your currency. Now, to be honest, that is not an exposure which is immediately going to materialize. That is really an exposure on paper. Till the time you sell that foreign operation, that is not going to materialize, and hence that is not an imminent exposure which you need to hedge. So over here, that is a brief explanation regarding transaction as well as translation exposure. And you move on into the last of the descriptive question, but definitely not the least. To add to your pain, the merger and acquisition chapter, which is typically a fairly straightforward. They've asked a very interesting question over here, and the next question along with that is like Scholes, you don't have any theory in point 6. So this is the last one, a descriptive, after which you have MCQs, which are also a bit ruthless. So let us review question number 6. Aerotech Industries, a listed engineering major, are evaluating the acquisition of MedGen Labs, an unlisted pharmaceutical laboratory. The financial parameters on 31st March 2025 are as follows. So you have been given for Aerotech, which is the acquirer, and it seems MedGen is a target. So this is PAT given, there is number of equity shares. So if you divide this, you can possibly get EPS if that is required. Maybe this is 12. Maybe 450 divided by 5, this comes to, let's say, 90. If it is required, this is like the EPS. Now the PE ratio is 30, and hence if I look 12 into 30, that comes to 360, which is a market price, and this is 90. But they say this is 1.2 times the industry average P. So if you can somehow crack the industry average P, then you can find the market price of the standalone fair value of MedGen Labs. Okay, additional information. Combined entities, so after merger, the post-merger PAT is estimated at 6850. Sir, ideally the post-merger PAT should be how much? It should be 6000 plus 450. So ideally the post-merger PAT should be 6000 plus 450, plus maybe there is some synergy. That comes to 6850. So maybe there is 6850 minus 6450. There is 400 rupees, which is worth of synergy benefits. Maybe it appears on a per annum basis. Okay, this is what it is appearing. This is including synergy. So the synergy effect, if you have to find, will be 400. The expected PE ratio of the combined entity is 34x. Okay, which means if I look at over here, for the combined entity, 6850 will be your PAT into 34 times. So this will give you your combined valuation, 6850 into 34. This comes to around 2,32,900 in case this has to be used. We are just trying to see what all is possible. The synergy value, the total synergy gain, that is increase in the combined entity value over the sum of the standalone values, is capped at 34,000. So this is your combined value. This is a value, not a per annum number. This is a value as on date, out of which we are saying 34,000 probably is attributable to the synergy, and hence minus 34,000. If I do 198,900 will be the pre-merger values, from which if I subtract Aerotech's pre-merger value, I should ideally get MedGen's pre-merger value if required. Now there are certain settlement offers which are there before you go to point 3 and 4. Let us see what is asked. Point number 1 and 2 pertain to the point 1 and 2 over here. Determine the annual post-merger synergies on a PAT basis, annual, which is I think 400, and MedGen's standalone PE ratio. Now MedGen's standalone PE ratio is 1.2 into the industry PE ratio, and second says calculate the industry average PE ratio and MedGen's standalone fair value per share. Now how do I do that? Well, I will say that ideally I can say that maybe 360 is the price per share and there are 500 shares. So maybe 360 into 500 comes to around 1,80,000. This will be the value of Aerotech. So if I do 360 into 500, this will be the value of Aerotech, and hence if I go back minus 198,900, I will come to 89,900. This must be the standalone MedGen value. Sir, how did you get that? Well, I've been given combined P, I've been given combined PAT, so I can find the combined value. Okay, so that is 2,32,900. I've also been told that 34,000 is the value of combined synergies, which means 198,900 is the value of the two firms, even if there were no synergies. I know that the pre-merger value of Aerotech is around 1,80,000, and hence 18,900 is the standalone value of MedGen. But this is the standalone value of MedGen. If I want to find, let us say, the number of shares over here is 5 crores. So if I do divided by 5 on a per share basis, 18,900 divided by 5, if I'm not wrong, this will come to around 3780. This will come to around 3780, which is a standalone value per share of MedGen. Okay, what is asked? Well, along with that, they're also asking you to find, well, this is your market price per share divided by the earnings per share, which comes to, I think, 90. So if I divide this by 90, I'll get 42, which is a P. But this P ratio is MedGen's P ratio. Well, industry's average, I don't know, that is X equals 42. So if I do 42 divided by 1.2, that is 35. So your industry P ratio is 35. It is lethal, I would say. So if I look at, let us say, the next question on mergers, I would say that yes, synergy on a pad basis in sub point 1, they're asking, well, I will say that this is 400, and MedGen standalone PE ratio, I'll say this is 42x. We just found that 42x. The industry PE ratio is 35x, and MedGen standalone fair value is 3780. So if I review all of this, well, the post-merger market cap is 232,900. From this, you deduct, let us say, so this is pre-merger market cap over here. Maybe I'm trying to find the market price over here. This is 34,000. If I do all of this working, I come down to 3780, which is a standalone price. Divide this by the EPS, comes to 42, which is a PE ratio. And if I want to find the industry average, this will come to 35. And this finally takes care of the first two parts of a question, which is completely new and different. So this is taking care of the first two parts. Now the next two parts are connected to the next 2 points. Now settlement offers, that is for one share of MedGen. So how much am I offering for one share of MedGen? So first is cash, 4,000, end of story. That is 5.82% premium over the standalone value. See, maybe this was 3780. If I do plus 5.82%, it is approximately 3780 plus 5.82%. This is around 4,000. This is offer 1 is cash of 4,000. Offer 2 is a hybrid offer where you are paying 1,000 of cash plus Aerotech share, premium of 21.69% over the standalone value. So how will I find this? Well, I will say ultimately the total value under this offer will be maybe 3780 plus 21.69%. So your total premium will be 3780 plus 21.69% will come to 4599 point something. This is 4,600. Out of 4,600, 1,000 is cash. Plus the balancing figure will be Aerotech shares, for example. Okay. Offer 3 is hybrid, where there's 1150 cash plus 5 convertible bonds of Aerotech. This is premium of 25.66% over the fair value. So there are multiple offers. We'll have to see what is asked over here. Otherwise, we'll keep on solving only. And the bond terms of Aerotech, face value is 500. This is the bond over here in the offer 3. With a 4-year term, 10% discounted. Each bond converts into 2 Aerotech shares or redeems at 680.24. So maybe this is like the straight value. That is, if I were to continue, what is the cash? Or maybe it converts into 2 Aerotech shares, and every Aerotech share is worth 360. So over here, for example, this is 3,600 balancing figure. So basically, if every Aerotech share is worth 360, maybe that is 10 shares of Aerotech, which you can back calculate. Sir, what is asked? Solve the number of Aerotech shares offered in offer 2. As we said over here, offer 2 is at a premium of 21.69%. So this is at 4,600, out of which 1,000 is cash, and the balancing figure is shares. So therefore, the 3,600 is the value of the shares, and every share is worth 360, and hence there would be 10 shares if I go to see. Over here, when I review offer 2, total consideration will be of cash and shares together, which is 4,600, and hence this is X is equal to 10. So offer 2 will give you 1,000 of cash and 10 shares of Aerotech over here. Rank all of these offers from MedGen's perspective. MedGen is the target. Target will prefer the highest. Assuming Aerotech's share price had fallen and remains at 330. So now it is not 360. Now you have to do the evaluation based on 330 at the time of settlement or at the time of conversion, as the case may be. Now if I look at offer 1, it does not really matter. In offer 1, there is a cash payment of 4,000. So let the Aerotech share be whatever cash payment is, 4,000. In the second case, in offer number 2, I would say that there is a cash of 1,000 plus there are 10 shares of 330 now, and hence this is what? I think this is 4,300. So offer 2 is at least better than offer 1. And then you go to offer 3. Now what is offer 3? Offer 3 over here says that I am ready to give you 1150 of cash plus 5 convertible bonds of Aerotech. Now I need to find the value of these convertible bond, and how do I find the value of the convertible bond? Well, it is a higher of the straight value of conversion value. So it converts into 2 shares of Aerotech. So 2 into 330 now, that comes to I think 660, or the straight value is 680.24. Now given a choice, convertible bond is the higher of the straight value or conversion value, and hence it is 680.24, at least if the price of the share is 330. If it was 360, then yes, conversion value would have been 720 and higher. However, that is not the case over here. So in offer 3, there is a cash of 1150, plus there are 2 convertible bonds which are worth how much? Well, 680.24, and hence if I take this working, this is what? 2 into 680.24 plus 1150, and this comes to what? Is that it? So this is plus 5 convertible bonds, not 2, sorry. So this is 5. Sir, you are also tired? Yes, 680.24 plus 1150. This is 4551.2, and this is the highest. At least if the price is 330, this is the highest, and hence offer 3 should be accepted from MedGen's perspective. So if I look at MedGen's, that is target's point of view, first is just cash of 4,000, second is cash of 1,000 plus 10 shares of 330, that is 4,300. This is cash of 1150 plus over here you will have just a second please. So this is calculated as over here the higher of the straight value or conversion value, and thereby you will get around 4551. This is the best, and this is best from the MedGen's point of view. And finally, now you proceed further into the last of the descriptive section questions, which is on Black-Scholes model. So this is on derivatives, and in the derivatives, we have done the Black-Scholes model. However, when you look at the Black-Scholes model, what is the formula? Well, the call option value is equal to S0, that is the price today, into ND1. Now, ND1 was calculated as a normal distribution value of D1. However, that ND1 represents what? Well, it represents delta. It represents the hedge ratio. It represents how many shares should you buy for every one call option that is sold. So ND1 represents the delta, or also called as the hedge ratio, minus the present value of exercise price using continuous compounding. So x upon e raised to RT into ND2. What does ND2 represent? Well, it is a normal distribution value of D2, which actually represents, if you look at the formula background, it actually represents the probability that the option will be exercised. That is, in case of a call option, the spot is greater than the exercise price. So ND1 represents the hedge ratio or the delta. ND2 on the other hand represents the probability of the option being exercised, that is a spot being greater than the exercise price. Again, you can use the formula to find, let us say, the call option value, and let us say in case you look at, let us say, the put option value as well, you can use the call put parity theory to find that. So if you can apply that, you are done with the Black-Scholes over here. So let us review this. The current price of F is 120, so that is S0, and European option with an exercise price of 115. This is your XP, will expire in 50 days. So this is your TT is equal to 50 divided by 365. You have to take this in years. The annual continuously compounded risk-free rate is 8%. Okay. The standard deviation of the annual returns of F is 30%. So this is standard deviation which is given. The value of D1 is 0.5375, not ND1. It is D1 given to you as 0.5375. The year is 365 days, and value of e raised to RT minus RT is 0.9891. So you don't really need to find that. Usually in Black-Scholes, the first step is to find the natural log. But the idea of finding the natural log is to use that for finding D1. Now, since D1 is given, you don't need to find the natural log. So step number 1 is not required. Step number 2, you calculate D1. D1 is already given. But from that, D2 has to be calculated. Well, D2 is calculated as D1 minus the denominator. So that is, let us say, standard deviation into the root of T. So over here, this is 0.5375 minus, let's say, 0.3 into the root of 50 divided by 365. So if I take 50 divided by 365, whatever that number comes, square rooted 50 divided by 365, it comes to around 0.136 square rooted. This is 0.3701 if I'm not wrong. So this is 0.5375 minus 0.3 into I think 0.3701 and hence 0.3 into 0.3701 will be giving you a particular value. So this is 0.5375 and 0.3 into 0.3701 comes to, I think, 0.4265 if I'm not wrong. This is D2. If you have to find D2, this is 0.4265. Find the hedge ratio. Sir, hedge ratio is nothing but ND1. The probability that the price in the spot market on expiration would be higher than the exercise price of the call option. So this is ND2. This is probability the spot price will be higher, that is the option will be exercised. So this is called as ND2. And value of call and put, well, if I can find ND1 and ND2, I have everything else. You have S, you have XP, you have e raised to RT. If I can find ND1 and ND2, which is required in the first 2 points, you can find the value of the call, and from the value of call using call put parity, you can find the value of put, and that is the end of story. But in this case, the cumulative area table, this is the cumulative area table which is given. So this is given for the entire area from the left tail. It is not just the area from the mean. If you are told area from the mean, then that is the area from the center. If you are given the tail area, that is the area at the end. This is the cumulative area table. So something like this. So it is giving you the area for this entire cumulative value. That is what is called as the cumulative area table. So over here you can have 0.5375. Oh, but I don't have this number. So I have 0.53, that is 0.7019, and 0.54, that is 0.7054. So basically you can use interpolation to find the number between the two. Similarly, maybe if you look at 0.4265, you'll have 0.42 and 0.43. Again, you can use interpolation to get the values between the two. Like if you are saying that maybe the gap over here is, let us say, how much? You want a movement of only 0.0075, then the gap will be how much? So over here, if I look at this particular case, since D1 is given, we are saying that we do not need to find the natural log. D1 is given, from that you will find D2, that is 0.4265. ND1 is n of 0.5375. Now, ideally, we round it off to 2 decimals, that is fine. But if it is given that D1 is 0.5375, we'll have to take the entire value. So this is 0.54, this is 0.53. You are taking these two values. I'll say that the difference over here is 0.01, which represents 0.0035. However, over here, if I want a gap to move from 53 to 53.75, this will be how much? If I cross multiply, I will get the answer. And loosely speaking, if I start at 0.53, if I add, if I say that for a movement of 0.01, the normal distribution value changes by 0.0035, I need to move by 0.0075. So it will move by how much? So you'll get 0.7045. It is somewhere in the middle over here. So this is ND1. What does ND1 mean? Well, this is the hedge ratio. Question can also ask you to calculate delta. Well, this is nothing but the delta. So what do we say? Well, we will long 70.45 shares for every 100 call options sold. That is a hedge ratio of 70.45%. Now you want to find ND2. You do it the same way. Like 0.43 value you find, you 0.42 value you find, and see the difference is 0.0036 for 0.01. I want a gap of 0.0065. So for 0.0065, it will be how much? You will find 0.6651. What does this mean? This shows the probability of the spot price being greater than the exercise price, and hence the option being exercised. So probability that the option will be exercised over here, that will be at ND2. And once you find these two values, you are going to apply, let us say, the numbers directly in your option pricing. So you have e raised to RT, which is, e raised to minus RT, that is 0.9891. And for the call option, you'll have S0 into ND1, which you have done, XP into e raised to minus RT, or divide by e raised to RT, whatever it is, into ND2. And this is 120 into 0.7045, 115 into 0.9891. This is e raised to RT into 0.6651, and you get 8.89. Now, once you do that, you have the call put parity theory. So many things to kind of remember. So this is C0 plus PV of exercise price equals P0 plus S0. This is P0, which is the only number which is missing over here. So you will take 120 as the spot price, 8.89 as the call option value, 115 into 0.9891 is the present value of the exercise price, and 2.64 is the put option value. It is a very, very, very memorable, a very lethal paper, a paper that is good if it is not coming in your exam. Now, May 26 has been bad. to be honest, truth be told, there's a lot of fear. Now it is my assessment that November 26 will not be equally bad. I mean, and to be honest, I'm no one to kind of predict that. However, our preparation should be for the worst paper. In the exam, whatever paper comes, we will accept, but our preparation should be for the worst paper. But you should not really panic as much, because I mean, this has come once in the institute's very long history. So let's prepare for the best, but we never know what is going to come. So what we can control is our preparation. So this takes care of the entire descriptive section. Sir, but at least MCQs would have been manageable. We could score marks in the MCQs. Well, unfortunately, the MCQs over here were also tricky, and they have gone to the nooks and corners and found the MCQs. So we'll even discuss the MCQ case-based scenarios now. So let us review the MCQs. The first MCQ case study was based on more of a sovereign gold bond, where you have been asked to calculate returns, capital gains, indexation. It seems to be more like a tax-based MCQ. But once you read through this, it is at the initial instant, like every other question, this is like a shocker. But this is, I would say, manageable. Let's review. The government of India issues a 5-year sovereign gold bond at an issue price of 5,000 per gram. An investor, Mr. JK, has purchased 200 grams under this scheme. So I must have, per gram is 5,000 into 200. I must have invested 10 lakhs. The bond carries a coupon rate of 2.5%. So 10 lakhs into 2.5% comes to 25,000 will be my interest. Calculated as simple interest on the initial investment amount, with interest being payable annually. At the end of 5 years, the bond will be redeemed at the prevailing market price of gold. So the redemption is not just fixed 5,000. It is based on the market price of the gold. The annual interest is taxable at the investor's applicable marginal tax rate, and any capital gains arising on redemption is taxable at 20% after considering the benefit of indexation. Okay, so capital gains is at 20%, whereas the regular interest is at the marginal tax rate. The inflation rate during the holding period is assumed to be 4% per annum. Okay, inflation will help you in, let us say, indexation. Usually when you find the index cost of acquisition, you will take the inflation. From the information given below, choose the correct answer. Mr. JK purchased 200 grams at 5,000. The investor falls in the 30% bracket and inflation is 4%. What are the post-tax interest income? So this is 25,000 and the tax rate over here is 30%. So this is 25,000 into 0.7 comes to 17,500. This is your post-tax interest income, and the approximate real post-tax return on initial investment, the real post-tax return, well, I would say that the return is 17,500 post-tax on an investment of 10 lakhs. But the problem is this will be the nominal return. So over here, if I go to see, this is 1.75%, but this is a nominal return. Now, what is the formula for real return? So the real return formula is 1 plus nominal. So the formula is 1 plus nominal, that is 1.075 equals 1 plus real, which I don't know, into 1 plus inflation, which is 0.04, and hence 1.0175 divided by 1.04, this comes to point. So this is 1 plus r will come to 0.9784, and hence if I take 2.16% or 2.2% approximately negative, so this is a negative 2.2% real return. So if I look at this 17,500 and 2.2% negative, this is option B. Next, after 5 years, the gold price becomes 6,800 and the inflation is at 4% annually. What is the index cost of acquisition? Well, the indexation happens in line with inflation. So this is 5,000 into 1.04. This is per annum, and this is after 5 years raised to 5. So this will give you the index cost 2345 into 5,000 comes to, I think, 6083 approximately per gram into 200, and this will come to around 12 lakh 16,000 and something. Okay, and the taxable capital gain to Mr. JK, so this is 12 lakh 16,653 approximately. And if I look at, this is the ICOA, index cost of acquisition. If I compare this with the sale proceeds, this is 6,800 into 200, which comes to, I think, 13 lakh 60,000. So if I take the difference between these two, I believe this will be what? This will be around 1 lakh 43,000. 347 will be the capital gain. Sir, it is like a tax paper. Yes, it is. But if you can get this, then what is the problem? So this is answer is D. Assume SGB redeems at 6,800 per gram and Mr. JK is in the 30% tax bracket. What is the net amount received after capital gains, which is 20% index, 20% with indexation? So basically, your capital gains is 143, 347 into 20%. Tax rate is 20%, and this is 13 lakh 60, which is your gross sale proceeds. So 1360 and 143, 347 into 20%. I think this comes to around 13 lakh, 31,300 and something, 331. So this is option C. So this is pertaining to the 3 MCQs. Now, next was on real options. So this is very similar to a question. So we have even given these workings for the MCQs as well. So when you look at the real options, similar to a question that we have, for example, in terms of the timing. So let us review this. Newchem is a leading chemical manufacturing firm based in Telangana, is evaluating installation of a new solar power plant to meet the energy needs for its primary unit. The initiative is a part of long-term sustainability and cost reduction goals. That is fine. The total cost of installing the solar plant is 3.2 crores. Okay, this is the cost, and based on current state electricity tariff, the plant is projected to generate savings of 25 lakhs per annum up to perpetuity. Okay, so this is based on the current tariff. But there's a regulatory uncertainty. A new state government is expected to take office in 1 year's time, and it is anticipated that the electricity tariffs will be revised. Now, based on industry analysis, the annual savings from the solar plant could change in one of the two possible ways. Well, there can be low savings of just 15 lakhs per year, or high savings up to 40 lakhs per year. Currently, the savings are 25. It can go low or high, as the case may be. The company's WACC is 9.5%, and the current risk-free rate of return on a 10-year bond is 6.5%. Risk-free return is going to be used in case of you use the binomial or risk-neutral valuation, whereas for project evaluation, we will be using the 9.5% return. From the information, you have to answer. So, Newchem plans to invest 3.2 crores in a plant, generating savings of 25 lakhs till perpetuity. The WACC is 9.5%. After 1 year, savings may change to 40 or 15 due to tariff. So this is the same thing which is repeated. Calculate the NPV if invested today. Okay, how will you find the NPV? Well, I will say 25 lakhs divided by 0.095. So this is 25 lakhs divided by 0.095. This is 263. Let's say this is in lakhs, 263.15. And there's 320 crores of investment. So the difference between the two will be a negative 56.82 lakhs. So if I take it in crores, maybe around 0.57 crores. So today there is a negative NPV. Also NPV after 1 year in both scenarios. Well, I would say that there would be 320 or 3.2 of investment, even in high or low. If I look at high, this will be around 40 lakhs or 0.4 divided by 0.095. This comes to around 4.21. And minus 3.2, maybe around 1.01. And in terms of low, this is 15.15 divided by 0.095. This is 1.58 approximately, minus 3.2. This comes to a negative 1.62. So maybe 57, 1.01, 1.62. Your answer should be C. Okay, next, again the same literature is written over here. Using the risk neutral valuation, compute the returns in both scenarios and the risk neutral probabilities of the high saving scenario. Now, the way institute usually does over here is, if I review, well, I will get, let us say, this situation where I have these negative and positive NPVs. And I will say that what is the probability of this going up? We'll say this is P. What is the probability of this going down? Which is 1 minus P. Now, the way ICAI does this is, they will say the rate, that is 6.5%, equals a negative, that is downward probability of 50.63% into P, and 31.56 into 1 minus P. I have first taken the low savings, then taken the high savings. So you can do it either ways. And if I solve for this, I will get ultimately probability coming to 0.305 for the low savings, 0.695 for the high savings. This is the probability. And the expected NPV, I mean, this is exactly the real option question that we do. There's nothing new per se. If you have done, I think, those 3-4 questions on real options, this is exactly the same. There is a 162 negative NPV, which has a 0.3 probability. 101 positive NP, which is a 0.695 probability, but that is after 1 year. Clearly told that the new government will take office after 1 year. And hence, if I were to take the present value of this will come to around 19.52. So this is based on binomial. And over here, if you review, the high probability is around 31 point something. So this is 31.56%. And the expected NPV is around 19.52. So if I look at the expected NPV, is that asked over here? Well, no, I mean, if it was asked, we would have done. So the high and low, so what is asked? Compute the returns in both scenarios. Oh, so we look at the probabilities. First, the probability of, I think this is 69.5 and 69.5, and you want to find the returns under both scenarios. We'll say that, okay, the returns over here will be a negative 50.63% and a 31.56%. So over here on a 101 is the NPV on a 320 investment. This is 31.56. 162 is a negative NPV on a 320 investment. That's a negative 51 approximately. So over here there's a low of negative 51 and a high of 31.56. I think the answer is A. Now when you look at option number 6, they are asking some weird thing. They are saying if I were to invest, all of this is fine. Compute present value of the option to wait 1 year. Ideally, there is no option to wait. I mean, you accept the project and then maybe you see what will happen after 1 year. Currently, no one is giving you any option to wait. Discounted at risk-free rate and the WACC. Now, if you see magically what is written at the end, you see what they are writing. There is no correct option for 0.6 because the question is also not correctly framed. Over here, the problem is no matter how you go round and round, you'll take one of them, and because the question is wrong, you would have gotten grace marks, and hence you should always attempt. Even if you think that the question is not proper, attempt something that will give you the grace marks. Over here, because the question is not properly formulated, there's an abandonment option to leave. There's no timing option per se over here that someone is giving you an option for which you are paying a premium that you can take a decision after 1 year. No, you'll have to take a decision now. Maybe what the government, well, it moves in a particular way, you will be able to know after 1 year. Like if I look at the current state over here, I will say the project is not worth accepting. It's a negative 57 lakh negative NPV. However, if let's say I look at a forward looking, well, there can be low savings or there can be high savings, but considering the probabilities and everything, there can be a possibility that there is a 162 negative NP with the 30% chance or a 101 positive NP with the 69% chance. And hence, maybe if I look at a forward looking data, forget what is there in the past. If I look at what is the possibility in the future, maybe this project seems to be worth accepting, but that is not what is asked. They are asking you to find the value of the option to wait. As an extra, one can always say, well, if I did not consider that, well, the NPV now was 57, with this is 19.52, maybe the difference is 76.52 and we discounted at 2 rates, but the answers still don't match. One can always say that as an extra working, maybe if I had the option to wait, I would have said that the expected NPV is 19.52 as compared to 57 today. So that is the additional value of waiting, and maybe discounted at different rates, but that does not match because the answer itself is not correct. There are two places, one is here and even behind in foreign exchange where there's a problem where this does not match. So this MCQ is wrong, and God bless you. Okay, next you go to case 3, which is on mergers and acquisition. It is more of a theory case on takeover defense techniques. So over here, X is professionally managed, providing consultancy services linked to mergers and acquisitions. It is on expansion mode and decided to hire fresh CAs. You will also go to an M&A team for M&A consultant. The selection of the candidate needs to pass a written test and following are some questions identified to know whether you know the mergers and acquisitions or not. Now, ABC, the target company, may issue substantial amount of convertible debentures to existing shareholders to be converted at a future date when it faces a takeover threat. This is a poison pill. The tactic used is called as a poison pill, where you are issuing many shares to, let us say, or debentures to let's say holders, which can possibly convert if there's a takeover threat. White Knight is getting someone who is I mean, I don't like the existing acquirer. I get someone else who can acquire. White Squire is someone else who is not really interested in the acquisition, but you get them, and maybe the management will then continue and they will just act like a sleeping partner. And over here, poison put is where you will probably put, that is sell, let us say, certain of your core items like crown jewel strategy, similar to that. Okay, then you have identified the correct meaning from the following regarding what do you mean by green mail tactics. Green mail tactic would mean when an acquirer comes to acquire you, you counter offer at a higher price so that the acquirer goes away, like you are reverse acquiring. So to defend itself from hostile takeover, when X issues bonds that encourage holders to cash in at a higher price, no. When X offers hefty compensation to its managers, this is called as golden parachutes, no. When X makes a counter bid for the acquiring company, merely making a bid is not green mail. Making a bid at a higher price, X offers the acquirer a higher price for its shares than the market price. That is called as a green mail. Next, you have 9. R is a parent company and J is its subsidiary. J is growing at a faster pace than R and it carries higher valuations than other businesses owned by R. To unlock the value of J and generate a cash, a strategic avenue which R may take is to make J go public through an IPO. But to keep a controlling stake in the newly traded subsidiary, such a tactic is called as, well, this is called as a carve out, I believe. So over here, yes, this is a carve out where you are carving out a particular division, listing them, and in a way unlocking value. So this is regarding theory for the mergers, and this is pertaining to your value at risk. So X is a portfolio manager with 25 lakhs invested in alpha and beta in the ratio of 60-40. So maybe in alpha you will have 25 lakhs into 60, that comes to around 15 lakhs, and in beta there is 10 lakhs. The daily standard deviation of alpha is 1.2% and beta is 0.9%. That is fine. So you have been given daily standard deviation. The correlation between alpha and beta is 0.6. So this will help you to calculate portfolio standard deviation. X wanted to measure the VAR for confidence interval of 99%, which I know Z is 2.33, and 90%. This is the new part, but they've given you the Z value, where the Z value is around 1.28. Assume 252 trading days in a year and mean return is 0. You have to solve these MCQs. What is the approximate annual value at risk? Not 1 day, 10 day, 4 day. You are asked annual value at risk for the portfolio in rupee terms at 99% interval. So for this, you first need to calculate the portfolio standard deviation, which is probably 60% into 1.2 squared plus 40% into 0.9 squared plus 2 into 0.6 into 0.4 into 1.2 into 0.9 into the correlation of 0.6. And if you do the square root over here, you will get the portfolio standard deviation, I believe, at around 0.9793. So this is portfolio daily standard deviation 0.9793%. Okay, into the value of the portfolio, which is 25 lakhs. So this is the daily standard deviation into, let us say, the Z value. This is at 99%, so this is 2.33 into the root of 252 days. This is the annual, and there are 252 days that is given. So 252 square rooted, that is 15 point something, into 2.33 into 25 lakhs into 0.9793%. So this is around 9 lakh 5,200 and something. So this is your option C. Now I would say 11th is an important MCQ. It is a slightly different MCQ as compared to the others. You might not have even done this in VAR. What is the approximate diversification benefit per day of the portfolio when you calculate VAR at 90% confidence? Which means if I try to find a portfolio VAR at 90% confidence, this will be, this is on a per day basis. Okay, so this will be 0.9793% into 25 lakhs into 90%. This is 1.28 into the root of 1. So this will give you how much? Well, 25 lakhs into 0.9793% into 1.28 will come to around 31,338. Now if I look at only alpha is 1.2% into 15 lakhs, okay, into 1.28 into root of 1, just alpha. If I go to see, this is 15 lakhs into 1.2% into 1.28, which comes to 23,040. If I look at only beta, this is 0.9%. I've clubbed this in the portfolio and that gives me the diversification benefits. So this is into 10 lakhs into 1.28 into root of 1. So this is, let's say, 10 lakhs into 0.9% into 1.28 comes to, I think, 11,520. This is 11,520. And hence, if I total both of these, I would say that ideally my total value at risk would have been 34,560. If I considered both of them individually, my total value at risk would have been 34,560. However, as a part of a portfolio, this is 31,338. And hence, if I take the difference between the two, that is 3,200 and something. That is option number D, which is giving me the diversification benefit. So this is 11. And then you go to 12. If the correlation between alpha and beta increases from 0.6 to 0.8, what will be the impact on the portfolio's VAR at 99% level? That's just trying to again calculate the standard deviation. So over here, if I look at the 12th MCQ, I will just take 0.8 over here instead of 0.6, and hence my standard deviation will be 1.309%, and at 1.309%, everything else remaining the same, you get 9,53,000. Earlier it was 9,05,000, which means there's an increase of approximately 48,000 and something. So there is an increase in VAR by around 48,000, and that takes care of your question number 12. And the last case, which is pertaining to foreign exchange. Now there are around 3 MCQs. Again, in one of them the treatment is not proper and it is difficult to reconcile, but the other cases you should be able to solve. So finally we are at the end, and you can see that it is almost, we have solved the entire paper in those 3 hours. Green Agro entered into a 3-month forward contract on 1st January to buy $2 lakh. Import payment which is due on 1st of January. So I'm basically an importer. An importer will buy at the ask rate. So if I look at the base currency, the base currency is, this is USD INR. And if you see, this is like a rupee per dollar. So I'll say if the base currency is a dollar, then the importer wants to buy, the banker wants to sell, the banker sells at the ask rate. So you have been given various quotes. How do you read these quotes? These are on 1st January spot rates. And this is the 3-month forward rates. On 1st February, the spot rates, and the 2-month forward rates, because I mean now 2 months are remaining. And 1st March spot rates, you have also been given 1-month rate and 2-month rates. In my opinion, what is relevant is the 1st March rate, which is 1 month forward. And on 1st April you have the spot rate. Again, I would say this is of no use. I would say this is also of no use in general if I look at only this given contract. So Green Agro enters into a 3-month $2 lakh forward contract on 1st January 2026. On 1st March, what is the maturity settlement cost? In maturity, I would say that if I had entered into this 3-month contract on 1st January, I would say that I would, as an importer, enter the deal at the ask rate, that is 84. So $2 lakh into 84 will come to around, I think, 1 crore 68 lakhs. So this will come to around 1 crore 68 lakhs, the maturity value. What is the net extra cost of closing the original and rebooking a 1-month forward? Now, if I close the original, I will have to take the reverse forward. So my original contract is, from an importer's perspective, a buy contract at the rate of rupees 84. If I want to cancel, I will cancel it by selling it. This is forward sale by 1 month. So on 1st March, if I look at a forward sale by 1 month, if I am selling, the banker is buying, the banker buys at 83.7. This is 83.7, and hence there will be a loss. This is 84 and 83.7 into $2 lakh. So this is 60,000. There is a cancellation loss of 60,000. So net extra cost of closing the original, well, the cost of closing the original is 60,000, and rebooking a 1-month forward. If I book a 1-month forward, well, if I take the 1-month forward now, it will cost me what? Well, I will have to buy. So banker will sell, banker sells at 84.05, which means I would say that the cost of the new forward contract will be $2 lakh into 84.05. That comes to 2 lakhs into 84.05 comes to around 1 crore 68 lakh 10,000. So as compared to my original deal, there's a further 10,000 more. So basically on loss on cancellation, I will, so one option is I would say that let me continue this contract, in which case ultimately I have to pay 168, or I can cancel it and pay 60,000 net and then enter into another contract at 84.05 and pay 1610 overall. So I will pay a total of 70,000 extra. So maturity value is 168 and extra 70,000. So if I review this case, you will have, let us say, maturity value as 168. Original you will cancel by 83.7. So there's a loss of cancellation of 60,000. 1 month forward will be at 84.05. So this is 168 and 10. So total extra cost is 60,000 as well as 10,000. So 10,000 is the difference of this and this. Additionally, you have to pay in any case 10,000 plus 60,000. So total cost is 70,000 over here. Okay, next you go into the next MCQ. If the import obligation is settled early on 1st March 26, this is early delivery. What is the total cash outflow that is required that day to close the forward contract and make the import payment? So usually if there's an early delivery, you have this swap cost and also interest. For interest you need the rate, which is I think not available. So even if you take the swap cost, if what are the steps? So over here for early delivery, you would say that you will find the agreed payment, which is 2 lakh into 84. This you have to pay 168, but you want to find the swap cost. So if the bank has to honor the early payment, the bank has to buy the dollars in the spot market on 1st of March. So the bank will go to the interbank market and they will buy. So the bank will buy and hence the interbank dealer will sell. So this will be at probably 83.75. So over here, this will be at 83.75. Now the swap says that if I'm doing a spot buy, there'll be a forward sale. So for 1 month in the interbank market, the bank will enter into a forward sale. So if the bank is selling, the interbank dealer is buying, they will buy at 83.7. So over here, this will be at 83.7. Now if I want to find the swap charges, I will say that, well, 167.75 will be the buying, whereas 167.4 will be the selling, and hence if I take the difference between these two, there will be a net swap loss of 10,000. So other than 168, which was originally to be paid, there's a swap cost of 10,000. So 168.10 on early delivery. Alternatively, an extra interest amount will also be levied, but interest rate is not given. So I will say 168.10 will be done under option B. Now under 15th, there's one particular place where I think there is an error, and you can correct me if you get that, but they have not given this properly, but we can infer the conclusion still. Green Agro Exports cancels the import and closes $2 lakh forward contract on 1st January, which was at 84 hours. They're telling you that they're closing. What is the mark to market gain or loss in the following date? That is, what if there's a gain or loss if you close on 1st February, on 1st March, or on 1st April? Now, if I have to cancel in this particular case, this is not exactly done properly, but if I have to cancel at this particular case, if I want to cancel on 1st February, remember my original contract from an importer's perspective is a forward buy, which is at the rate of rupees 84 per dollar. So the cancellation will always happen using a sell contract. So maybe a forward sale. If I am selling, the banker is buying. So all of these will be the dollar bid rates. But this is a 2-month forward because this is on 1st February. So 2 months are remaining. So this is the 2-month forward bid rate. Maybe this is 83.95. So this is at 83.95. So there would be maybe a loss. If I go to see 83.95 in minus 84 into 2 lakh comes to 10,000. So this will be, let's say, the loss in February. Is that available in some of the case? Yes, there seems to be a loss of 10,000, which is there in option A as well as option D. Then you go to 1st March. Again, if I have to cancel, I'll cancel using a forward sale at again rupee per dollar bid rate, but this is for the 1 month forward. So on 1st of March, if I look at the 1 month forward bid rate, this is 83.7. This is 83.7, and hence the gain or loss you will say is you are selling at 83.7, buying at 84 into 2 lakhs. So there is a 60,000. loss over here. If I look at the mark to market on March, if I look at that, well, on March, the mark to market is 60,000. That comes in option A. Now, ideally, which means even if I don't see anything for April, my answer should be A, because that is the only place where my Feb and March gains are reconciling, and hence the institute has also taken A. But if I actually sit to find for April, the April answer, I don't know how that April answer is coming. It is not calculated in a proper way. So if I look at April, for example, the cancellation over here should be at the offsetting spot rate. So if I look at 1st April, though this is extra, your cancellation should ideally be at the spot sale rate. So if you are selling, the banker is buying. So this will be at, I think, 83.2 if I'm not wrong. So this will be at 83.2 and this is at the spot. So this will be 83.2 minus 84 into, let us say, 2 lakhs, and this comes to around 1,60,000 loss. Again, if I'm looking at April on the mark to market, these numbers, none of these numbers are tying up. So maybe the April version is wrong. But even if I ignore that, the only way in which I get the February and March numbers correct is by, let us say, taking, so I have taken these rates, which is 1, 2 and ideally 3. This should be my cancellation rates that you should be looking at, and the answer you can see is option A. And option A, I would say that these two are correctly done. The last one, I'm not very sure, but there is no other option where the first two are correctly done. So you can pray to God and select this option. And that, ladies and gentlemen, boys and girls, takes you to the end of arguably the most challenging paper. Even while discussing, we took a little more than 3 hours. I don't know how the students managed to do this in 3 hours. Hats off to everyone who attempted this paper. It was one of the most challenging papers, and we really hope that we kind of get papers which are a lot more aligned to what is there in the study material. And I mean, again, there can be new questions, but the entire paper made like this may not be the best way to kind of test a student's preparation. But nevertheless, we are preparing for the best, and we are also going to share, and you can review that on Telegram as well, the PDF for the new questions. There would be around 50 plus questions in that on concepts where maybe the institute can formulate a numerical based on what is there in the study material, but for which the institute has not given any separate numerical questions. So we have formulated a file as well, which may be helpful. We'll if possible, you can just review that and build up your understanding along with the theory that is there. But other than that, just keep studying hard. I know that this paper was something which kind of shook the confidence of the best of the students. Forget that, the best of the faculties as well. And this is a paper which I would say that should be looked at more like an exception rather than the norm, and that should not define your study pattern. Like, the fear of a paper like this should not continuously run in your mind. I'm saying this is easier said than done. If I was a student, I would have thought about the same thing, that what if a paper like this comes? Well, the only way, the only antidote to that is by doing holistic study, doing full study, trying to understand the concepts, the logic. Like, you know that how do you identify the cutoff points, and using that, maybe in Black and Scholes, what does ND1, ND2 represent? Maybe looking at lot of these concepts can help you solve a lot of these questions. Again, just collating resources from 20 different sources is not going to take you anywhere. That is like an endless pit. You'll keep on going down and down in the rabbit hole. How many questions will you get? You'll keep on going to the AI and you'll keep on generating more and more and more and more. There's no end to that. Can anyone guarantee that these are the questions that will come in the exam? No. So which means what you should focus on is on the core library that you have, the core material that you have. Whichever faculty, whichever material that you have would be based on largely the institute material. Maybe take 1 or 2 supplementary materials, let's say of some professors, to kind of acclimatize yourself with a different type of a question that can come. But beyond that, focus more on maybe understanding the why and understanding how. If you understand the steps on how to solve and why a particular formula is formulated, more likely than not you should be able to solve. And keep putting one foot in front of the other. If you get stuck up at a point that, no, I want to become the master of this, well, that is not how it will work. Like there is this saying, and which is an incomplete saying. You say master of jack of all, master of none. This is still better than master of so over here. So in this particular case, you should try to be a jack of all trades, cover everything which is there, do that properly. And I'm sure with the kind of efforts that you're doing and the kind of detailing that you're trying for AFM, I'm sure in November 26, AFM is going to be a standout paper for a lot of you. And my blessings, prayers is there with all of you. Keep on studying well. I'll see you with more such content which is helpful. If you do like the video, please press the like button, share it with your friends. If this was helpful for you, gives us a bit of encouragement as well. So I'll see you with more videos, and wish you all the very best. Study hard, study well, keep smiling, and take care.